a big change from the Fed.
The Fed definitely caught up with the market pricing of rate hikes for the next couple of years.
I think the Fed's forecasts are still remarkably optimistic.
Fed rate hikes just take a really long time to impact the economy.
All these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The sell-off resumes from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures negative, more than 2%. TK, the S&B behind us this morning. The Bank of England up next.
Yeah, it's every central bank for themselves, and you wonder where the Bank of Japan slips into this. John, the set of news here right now is so extraordinary that we need essentially to stagger from the hawkish out bank by bank by bank. How do these hawkish bankers, led by Chairman Powell, deal with OECD 2.8% global growth next year? Is it a forced recession? Is it a forced global slowdown? That's the bigger picture this morning.
What did Scott Minerd say yesterday, Tom? We saw it there in the opening part of this program. Fancy land again. He does not believe in those forecasts by this Federal Reserve and believes they could be a whole lot worse.
Mr. Minerd has an opinion, but far more importantly, John, we need to redux what Bill Dudley said yesterday. Zero Hedge led with our interview yesterday in their postmortem. And the answer is the president of the New York Fed, the esteemed William Dudley, was scathing how this is a rose-colored view.
Rates are going up, yields are going up. Lisa, the market's doing the talking this morning. Equities down, yields higher, not just on treasuries. Look at bonds. A 10-year bond, 180, up 18 basis points on the day.
The ECB is going to have to act, and that's the clear message that we got. Also from the S&B, the fact that the Swiss National Bank raised rates for the first time in 15 years, and not by 25 basis points, but by 50 basis points, by 0.5%. How much does this put the pressure on the ECB, saying it is your turn? Everybody, except for the Bank of Japan, is responding to this inflationary wave. You do too.
The second time we've seen this, Lisa, a big rally on Fed Day, and then a big sell-off the day afterwards. It's almost as if we're fading something, then not quite buying it afterwards. It doesn't really add up, does it?
Yesterday's move didn't really add up.
We were
talking about that. There was nothing in the statement. There was nothing in the press conference to give risk assets any comfort whatsoever. And we heard that from strategist after investor after economist. This is basically the Fed saying we are willing to risk a recession in order to get inflation under control. And that is not a comforting message for risk assets.
Equity futures right now down around about 2%. Let's whip through it for you. On the NASDAQ 100, we're down by 2.6. Keeping a close eye on what's happening in the bond market here. Yields high by 15 basis points to 340, 369. Just yesterday in reverse in many ways. In the FX market, euro dollar clinging to 104. The first rate hike from the S&B in 15 years, Lisa. It's been a while. Euro dollar negative 0.4 to 1%.
And so now the Bank of England is up at 7 a.m. with that rate decision very much in the forefront. The expectation here is for them to move possibly by 0.5 percentage point at the fifth consecutive meeting that they will be moving and raising rates at a time where they're raising rates into weakness. The pressure is on to raise rates. And I know that, John, you've been talking a lot about this, how there is a need to defend the strength of a currency, which is a complete reversal of what we have seen over the past few decades. What we're seeing today is the pound losing steam. We have seen that consistently weakening versus the dollar. It's also weakening versus the Swiss franc. Again, it's a race to see tightening from the central banks in order to support the currencies. And that is what you're seeing today with the pound losing and 119 versus the Swiss franc. At 8:30 a.m., we get U.S. building permits and housing starts, as well as U.S. initial jobless claims. The U.S. unemployment rate very much in focus right now, given the fact that we're at 3.6%, near a historic low in the unemployment rate. Basically, Fed Chair Jay Powell conceded yesterday the unemployment rate has to go up. What's the projection right now? 4.1% unemployment rate in 2024. Perhaps that is fantasy land. Perhaps, as Bill Dudley said, they need to indicate more pain ahead. Right now, this is the pain point. How many people will have to lose their jobs in order to get inflation under control? And today, German Chancellor Olaf Scholz, French President Emmanuel Macron, Italian Prime Minister Mario Draghi, all heading to Ukraine for talks with the president there. This as natural gas prices surge yet again in the euro euro region. How much can you get inflation under control, John, when you have that geopolitical risk hanging out there and the conflict continuing to brew?
Europe has so many problems. Lisa, thank you. Arcelinios joins us now, the global head of FX strategy at RBC. Arce, let's start here. Do you think we might be in the foothills of a currency war?
I wouldn't term it a currency war because what banks are trying to achieve, what central banks are trying to achieve is very different. Here, actually, currency strength can be a good thing in that it helps you target imported inflation, whereas typically we think of currency wars as trying to artificially weaken your currency.
That's what I'm trying to get at, Arce. Is it the last decade in reverse? Is this a very, very different kind of currency war compared to what we've seen in the past? A currency war, nevertheless, but with a different objective, and not everyone can win.
Well, I guess the difference here is that we're not going to see active intervention with one or two possible exceptions. I mean, we've talked a little bit about the Bank of Japan, but we're not going to see active intervention in order to generate a stronger currency. But we will see is central banks taking into account the impact of policy on the currency and how they can generate that higher imported, lower imported inflation. So I guess I wouldn't call it a currency war because the currency isn't going to be the main tool. But certainly, I think where you're absolutely right, central banks are going to be far more comfortable looking for a stronger currency against their peers.
Also, to borrow from the wonderful William Rhodes, is this coordinated? Is Powell central banker to the world, or is the bond market central banker to the world?
Well, at the moment, it feels like global inflationary pressures have the upper hand, right? And that's, I think, what we heard yesterday. In traditional times, central bankers would focus on core inflation because that's the best predictor for future inflation. And yet, at the moment, with headline so high relative to historic periods, we're actually seeing that feed through into inflation expectations. And that's really what has central bankers worried.
Right now, we're also looking at a race to tighten rates the quickest in order to deal with the inflationary input. How much do you think, perhaps to John's point, we're not necessarily going to get a currency war, but we will get pressure from central banks and other central banks to raise rates simply to keep pace, to not increase the inflationary pressures in their economy?
Yeah, and I think that's what we saw this morning with the S&B. I mean, that's really notable. As you said, first time in 15 years they're raising rates. And this is a central bank which up until very recently was actively intervening, trying to weaken their currency, really targeting a much weaker currency over a very long period of time. And here we have the central bank stepping away and not just hiking rates, but surprising markets with a larger than expected hike. That's a very clear signal of intent. And like you say, it does create some pressure whether or not others will choose to follow.
Elsa, what do you expect the ECB will do in response to this, given the fact that you are seeing that tightening from even the Swiss National Bank? Are they going to come out and surprise to the upside? And will that be positive or negative for the euro?
They're in a really difficult spot, right? And here is where you see the impact of making monetary policy for such a disparate group of economies really coming to the fore. Because yes, on the one hand, they'd like to go faster. They do have the same inflationary problems a lot of people do. If anything, commodity prices are much higher in Europe than they are elsewhere in the world. But then at the same time, as rates go up, that's causing a lot of pressure on the periphery. And so yes, we heard that kind of extraordinary meeting yesterday. They promised to come up with some new tool, no details as yet. I do think that the fact that they're considering fragmentation will actually keep them near the back of the queue in terms of hiking rates. And so I've got to say, from a cyclical perspective, I'd be a little bit more negative on the euro.
Also, what does EM do here? I mean, away from the major currencies and the power of these economies, the sophistication of their financial systems, forget about Ecuador and Bitcoin, or I think, no, Costa Rica. I can't remember which one, John, is based on Bitcoin right now. Yeah, El Salvador, excuse me. Okay, forget about that. But what does EM do when the big boys are lifting rates?
So I think the hope for a lot of people was that if you rewind back a few weeks, the narrative was you had temporary lockdowns in China, but you've got the Party Congress coming up in October, and we were expecting, or markets were expecting, there to be big fiscal stimulus delivered ahead of that. But what we're seeing in practice is that zero COVID policy is very difficult to execute, and what you'll keep seeing is ongoing flare-ups and renewed need for restrictions and lockdowns. And so I think with China somewhat on the sidelines, that really puts the rest of EM in quite a tricky position. You know, we saw that with the BCB. They have been looking to end their tightening cycle, but it's very hard to do when the currency is coming under so much pressure.
Elsa, thank you. Elsa Linios there of RBC. Lisa, we've got to fully realise some really, really big issues. It's the last decade in reverse. We're now trying to engineer stronger currencies after trying to engineer weaker ones for the last 10 years. Not everybody's going to win that game. And I think we're seeing that play out in foreign exchange right now.
You know, you said it really well yesterday when you said that it was the race to the bottom, and it was a much easier race when that was the case, when there was no inflation for the central banks. This is a very uncomfortable race. Is it a race to tighten policy the most? And then at what point is that going to be negative for currencies if that indicates even slower growth going forward?
Central bankers, Tom, don't like to talk about the FX channel, but if you import so much inflation, I think the Bank of England in focus a little bit later this morning for us. When you do that, the FX channel is so important. What remains to be seen for me is if the Bank of England went with a bigger rate hike today, would it do damage to the currency, or would it actually be positive for the currency?
Yeah, this is really, really important, folks. And this is a cultural aspect, a political aspect, and also just the simple, blunt differences of these different economies. John, I totally agree that currency analysis here is important, but I would look at the magnitude historically, and as was alluded to yesterday in our conversations, we really haven't seen a magnitude move in rates yet. We are hawkish. Everybody's having, to borrow from Bart Simpson, the economist, a cow about it. But John, we've just barely begun to move.
We've got a central bank forecasting higher unemployment, Lisa. That's always an uncomfortable moment for any central bank that has to do that.
And they kicked him up to, what, 4.1% by 2024?
Yeah.
And what did Bill Dudley say? Still fantasy land.
Still fantasy
Still
land.
not real.
Scott Minard said the same thing. With Lisa Abramowicz this morning, I'm Jonathan Ferro, together with the man from Del Monte. And if you're not British and you don't get that joke, Google it. From New York, futures down 2% on the S&P. This is Bloomberg.
First squeeze tang.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The leaders of Germany, France and Italy are in Kyiv today for talks with President Volodymyr Zelensky. Olaf Scholz, Emmanuel Macron and Mario Draghi travelled together by overnight train in a show of solidarity for Zelensky and his government. The trip comes ahead of an expected recommendation Friday from the European Commission that Ukraine be granted candidate status to join the EU. And some NATO members are looking to Germany for cues about how to boost the alliance's defenses against Russia. Bloomberg has learned the allies are considering adapting a new German model in their long-term defense planning. Germany's been identifying units that can be deployed to Lithuania at short notice and placing key equipment ahead of time. It's an alternative to basing new troops more permanently in the most vulnerable member states. And the House committee investigating the January 6, 2021 insurrection of the U.S. Capitol will focus today on the pressure then President Donald Trump put on Vice President Mike Pence to block congressional certification of Joe Biden's presidential election win. The panel will hear that Trump was repeatedly warned his plans were illegal. The hearing may include testimony from Trump aides that when Trump learned rioters invading the Capitol were calling for Pence's lynching, he responded by saying Pence, quote, deserves it. The chief White House medical advisor, Anthony Fauci, has tested positive for COVID and is experiencing mild symptoms. He has not been in close contact with President Biden or other senior government officials, but will self-isolate and continue to work from home. The 81-year-old is fully vaccinated and has been boosted twice. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting.
That seemed to be enough to lift this equity market. It just didn't last long.
Just rocked, yeah.
Fed Chair Jay Powell.
How about that rally?
At yesterday's news conference, it fades Tom and fast. We're down 2% on S&P 500 futures, on the Nasdaq 100 down about 2.5. Looking at crude, negative about 0.25%, 115. The president wrote a letter to some of the big oil players. The White House did. Exxon snapped back. I'm just going to bring you some of the numbers that Exxon delivered. Here's one quote. We kept investing even during the pandemic when we lost more than 20 billion. They wanted to emphasize that and had to borrow more than 30 billion to maintain investment to increase capacity to be ready for post-pandemic demand. They make all these points, Tom, about investing in America, et cetera, et cetera, et cetera. Then they have some tips for policy at the end. The letter concludes by saying, longer term, government can promote investment through clear and consistent policy that supports U.S. resource development. Tom, a bit of a snapback from Exxon yesterday.
A bit of a snapback, and it's really off the radar this morning. Brent crude 124 down to 118. I guess it's a give back. But John, within all of this battle over commodities, and particularly hydrocarbons, I saw Jeff Curry with us earlier this morning on Bloomberg. John, European nat gas speaks volumes. It's not out to February 24 in the beginning of the Ukrainian war, but it's day by day there's a different hydrocarbon to get your attention.
And the news from Gazprom, I think it was yesterday, Tom, maybe just restraining some of the supply into Europe. Might not be a massive story for the Europeans right now, could be an even bigger one further down the road.
Right now, we are going to digress, and this is a story that I think internationally needs to be told. Richard Nixon was buried in 1967. There was a small matter of a war in Vietnam, and he resurrected his political career with a war on crime. And it worked. Jeff Fitzpatrick joins us right now with a Republican formula that was shocking on Tuesday. Jack, this is from Brownsville to Corpus Christi, Texas, and on the grave of LBJ, the arch Texas Democrat, the Republicans are winning, and I would suggest winning big, worried about crime, worried about the border, just worried about getting that Hispanic and black vote they're not supposed to get. This is a seismic change for American politics, isn't it?
It represents a lot of significant things that look very bad for Democrats. This special election that went to Mayra Flores pretty unexpectedly, the Republican who won the special election for Filimon Vela's seat. There's still going to be a competition in November because this is replacing someone who stepped down. But one, it shows you that, Democrats on one hand have not necessarily put a ton of effort into a state like Texas, despite maybe their dreams of turning that blue presidentially someday. Two, they already knew they had bigger problems than they initially thought with Hispanic voters at large, especially looking to Florida, more conservative Cubans. But they can't lean back on some opposition to Donald Trump now that he's not president. The border wall debate is not in the news cycle. It's not an issue right now. And it raises questions about what kind of demographics the Democratic Party may have taken for granted for a long time that they haven't organized around and sent a message directly to in recent years.
I am absolutely fascinated how President Biden, and let's assume for the sake of discussion he's a one-term president, how does he lead his Democratic Party back to the assumption of Hispanic and black ownership? They're leaving in droves. Statistically, it's irrefutable.
Some of this, it's a bit of a patchwork. It's very difficult to pin down, when we say that the Democrats are struggling with Hispanic voters, that is such a broad group with different subgroups that it's very difficult to point to a reason. One of the bigger reasons, and maybe this is more of a Florida issue than a Texas issue in this one special election, but it does largely come down to economic views, at least least in some cases. If you're running on a weak economy, you can lose a lot of voters who you may have taken for granted in recent years. You're also right to raise the crime issue that affects them in many places around the country. Biden has probably dragged the Democratic Party back toward the center in how they talk about police and that kind of thing. But it is still a tough issue, and it's going to be a tough series of midterms.
John, I can't say enough about, for a certain vintage, this vote Tuesday was absolutely stunning on the Texas Gulf of Mexico border. I mean, it's once in a lifetime kind of vote.
Jack Fitzpatrick down in D.C., TCAL was following the same thing. More broadly, going into the midterms, Lisa, just things heading in the wrong direction for this president on a whole series of issues.
Well, and Tom asked the question, how does this president lead with respect to getting Hispanic and black votes? I could make the question much broader than that. How does he lead if so many people are saying that he's going to be a one-term president? Not very long ago, the expectation for recession this year was nil. Now it's something like 70% if you take a look at Bloomberg Economics projections. So how does he lead when so many people are saying he's inevitably going to be a one-term president?
You ask the perma bears about the economy, they'll tell you the same thing every single time. When you see slightly constructive people or more than constructive people turn quite negative on the outlook, that's what gets my attention. To hear from Neil Dutta yesterday, to hear from him in the news conference and really raise some questions about where this Fed was heading in a not very constructive way. To hear from Wells Fargo, almost as the news conference finished, they put out this note. Indications that inflation is becoming more entrenched in the U.S. economy has caused the Federal Reserve to become even more hawkish. We now judge that recession next year is more likely than not. More likely than not, Lisa. This is what this market's been adjusting to now for weeks, if not months.
Yeah, that Jay Bryson note caught my attention as well, because they said that they expected a soft landing just a week ago, now no longer. And how much does the Fed respond to that by saying, you know what, maybe you're right, but we have to get inflation under control? And that was the message yesterday. To me, the biggest takeaway, and it was not the stock market rally or the bond market rally, which we rejected yesterday, is not really necessarily cohering with the message from the news conference, but really this idea they are willing to risk recession, period. End of story.
They will never talk about that openly, though, Tom. They will never talk about that openly, and they're never going to forecast it either. So I don't think we can complain too much about that. We can't complain too much about that. Fact of the matter is, for a lot of people, their view on the Fed has changed. They've had to change the timeline. I think they've had to change the destination as well, the peak, and ultimately what that's going to mean for unemployment
I'm
versus,
focused on the timeline,
growth.
and so is Ellen Zentner. I thought her note this morning was just absolutely brilliant. I took some real shade yesterday, John, from people thinking I'm over-analyzing a two-part inflation. There's a path from 9% to whatever percent, and then it's the move from that lower percent down to 2 or 3 that's going to be so difficult. Ellen Zentner looking for steeper vectors right now.
Futures on the S&P negative a little more than 2%. NASDAQ 100 futures down by 2.7. Yields biting back up 15 basis points. Heard on radio, seen on TV, this is Bloomberg Surveillance. Equity futures this morning, and good morning on TV and radio. We look like this. We're negative by more than 2% on the S&P 500. Taking back yesterday's rally on the NASDAQ 100, we are down by 2.8%. This Federal Reserve with an outlook that includes higher interest rates. They hope lower inflation, but also higher unemployment. That's got everybody's attention. And for some, that's too constructive. Almost fantasy land for the likes of Scott Minerd and Bill Dudley too, the former New York Fed president. So that's the equity market. It's yesterday in reverse in the bond market too. We look like this on 2s, 10s and 30s. Yields in yesterday, up today by 15 basis points to 343.50 on 10s, on 2s, up 17 right now to about 336. Look out Germany too, the bond market breaking out through 180
John,
on a German 10-year, Tom. That got your attention. It got mine too.
This is wicked important, folks. You not only look at the spread, you look at the levels. And Germany, Italy, John, today speaks volumes. The fact is Italy hasn't given it up. It's still near 4%.
Tom, that spread was inside 100 basis points last year, back through 200 over the last couple of weeks.
I'm sorry, there's way too much spread analysis and not enough level analysis right now.
Tom, I'm with you. Yeah. We have to fold all this into the FX market too, so let's take a look at what's been going on. The Swiss National Bank out with a surprise 50 basis point rate hike, a stronger Swissy, Euro-Swiss one to watch, Euro-Dollar another one. Euro-Dollar 104, negative a third of 1%. If we're importing a lot of inflation, we've got a problem in the FX channel for Europe. We've got a problem in the FX channel for sterling. The Bank of England's up next, Tom. This is an important one. 121.57, we're down about 0.2%. In an ideal world, you'd engineer a stronger currency to attack some of that imported inflation. I say in an ideal world because I'm not sure many people are convinced that if you get a big surprise, a big move from this Bank of England today, that you actually get a stronger currency in response to that. I'm not saying you won't. I'm just saying it's very much up for debate, and that debate is
John,
very divided.
I want you to inform us here. You've been in the room. That I perceive the Bank of England as a more fractious institution. Is Bailey speaking alone today for a committee, or is he speaking thinking of the Prime Minister under siege?
Tom, I'll say this. Whenever a central banker, a leader of a central bank, speaks in a news conference, they have to try and reflect the consensus that exists on the committee. The problem is that at an institution like the Bank of England right now, there are so many different views in different directions that it's hard to form a committee, form a consensus, and then represent that consensus live on air as they talk to us, as they talk to the audience, to the journalists. So I think that's the number one challenge for Governor Bailey today. How much dissent do we start to see, Tom, again, around this Bank of England and the way forward? And let's not forget, I thought it was interesting yesterday that we had some dissent from someone that traditionally, Esther George, would be considered a Fed hawk, who only wanted 50 basis points at yesterday's meeting. I know it wasn't the big story, but it's something we could talk about on the path forward.
We're scheduled to have breakfast with her at the Pioneer Grill, where I'm going to have a full Wyoming. We're looking forward.
At the end of August.
At the end of August at Jackson Hall.
Just
right
to
now,
explain that to people.
Let's slide over to the equity markets right now. Andrew Sliman joins us, Senior Portfolio Manager, Morgan Stanley. Someone who is in equities, someone who is congenitally long and optimistic, except maybe he's not. He joins us now amid the gloom. Come on, Andrew, the gloom. There's blood on the streets. Do you load the boat here?
Look, I think there's an opportunity coming. I just think it's too early. It's the stock market, regardless of your view of the economy. My view is basically the stock market's got a hard time with 10-year where it is, given the multiple that remains on the market until we get resolution in terms of interest rates and inflation. I just think it's too early to get aggressive, but it's out there. It's just too early.
Amid the gloom, what is the lesson on use of cash? We saw D.E. Shaw go after FedEx. They've amended. We saw Target with a big dividend increase as well. How does use of cash change given the gloom that's the Bramo-like gloom that's out there?
Well, it is interesting that, you are seeing companies increase stock buybacks. You're seeing insider buying. So I think there is some reason to believe that the collapse in earnings won't be there. And I think that's a lot to do with inflation, frankly, that companies can pass along their inflationary costs to the consumer. The question becomes, will they be able to maintain the margins, or will consumers push back before their costs come down? And right now that has not happened. So companies feel pretty good about their business and they're raising dividends, buying back stock. That's what's happening now. We haven't seen the collapse in margins that many of the bears had predicted.
So, Andrew, let's say that we do get a continued sell-off, as many people do expect, as the real yield, not only the nominal yield, but the real yield in the United States resets to levels that we have not seen since 2018 and earlier, depending on which measure you look at. When are we there? When do you start saying, we have baked in the depth of the pain, let's go?
Well, I think, first of all, timing. It would be nice to be a little bit later into the summer, because I suspect another 75 basis point increase will cause further catharsis. It would be nice when you guys are out having your burgers in Wyoming or whatever you said, Tom. If the Fed were to, ease up, I think that would be good. So timing first. Number two is, where did the market go? If it gets down, it's 16 times forward earnings. If we start to see 14 times, in the, kind of mid 3,000s, I think that would be helpful. Or if you saw rates back off to closer to 3%, which clearly is not happening today. We're starting to see some inflationary inputs weaken, but certainly not oil. And there's too many things driven by oil prices. So inflation backs off, rates back off, or the market comes down to a multiple that's more reasonable with 3.5%. I think those are the two scenarios. And I suspect all that will happen going into it later this summer. I just think it's too early. So you remain defensive until then.
Andrew, what does it mean to remain defensive when you have to be fully invested?
Yeah, I mean, for me, look, I think we want, okay, so number one is what's amazing is, what is working year to date? Energy, utilities, defensive stocks. Those are late cycle stocks. The market has told you that we're into a slowdown. The way you position as a long equity manager is make sure that your beta isn't above the market. Make sure you have plenty of these defensive stocks and energy. The however, though, Lisa, is early cycle is the consumer stocks. And those have been absolutely crushed. There are a ton of opportunity in consumer stocks. And as I said before, when the consumer sentiment is at an all-time low, you have to stand up and say, the rate of change at some point is going to be, positive. And I think those are the types of stocks you want to start to prepare, do the analysis on, because I think that's the next, what I would call the next fat pitch, is to move into more of these early cycle stocks. I just think it's too early.
Andrew, are you saying that it might be time to think about fading some of the energy move then, after the monster rally we've seen in energy stocks?
Yeah. Well, so Jonathan, here's what's interesting. So the utility sector through May had outperformed the S&P by 1,500 basis points year to date. Utilities are fading, right? So they have faded going into June. So I just wonder whether we're going to look back and say, we were in a recession. We're already in a recession. And the playbook would say then you want to start to fade the late cycle. If you tell me, Jonathan, the recession is, end of the year or next year, then it's too early to sell energy. It's too early to, begin to reduce the defensive. If you tell me we're in it now or it's happening, then, yeah, I want to get, I want to start to fade those.
Andrew, that R word, though,
I know
what does it mean? If we were in a recession, and let's say it was right now, whatever that means, what kind of recession would you be expecting? I see that R word get thrown around all the time.
Yeah,
what kind of
exactly.
downturn would you be expecting?
Well, what we're getting. The problem with a deep recession right now is you're not getting the fundamental drop-off that the big earnings destruction. Now, what scares me is you're starting to see some of these financial issues, like Swiss Bank raising rates. My contention has always been ultimately, unfortunately, something breaks in the system, and it, kind of not a very nice way to say it, but a dead body floats to the surface. That's the kind of thing that marks bombs in recessions, but. You're right now, as we sit, if it is going to be a shallow recession because we haven't had the drop-off in fundamentals to the magnitude of a deeper recession.
Andrew Sliman, nuanced view, as always, sir.
Andrew,
and good to catch up with you from Morgan Stanley Investment Management. TK, a lot to think about on the energy front and elsewhere.
Well, it is. And the energy front is front and center. Certainly politically, it's front and center. John, I would not only take I thought your recession comments there were dead on, and that I would take the recession comment and split the GDP equation to the domestic equation and the foreign input equation, export imports. And I wonder if you're going to have a two-part dynamic where you get a negative print on recession. You get the gloom of a recession, but you get it with a pretty good American economy while we import so much stuff that it drives us into some form of growthy recession or
You're describing the first quarter, aren't you?
Yeah. Well, John, I mean, there's courses that are taught like this. I think Northwestern has the best source, Robert Gordon, where you have a growth recession, John, and you also have a Bramo recession, and that is a different recession.
The Bramo one, if you get that, you do not want to be in energy. I'm not sure, Bramo, you want to be anywhere invested in this market.
You just hide under the blanket. You're saying that if I had my way, everyone would just basically be under their covers hiding. No, I don't want to paint that picture. I hope that this is actually going to be a shallow recession. What struck me from the news conference yesterday was the lack of control that Jay Powell seemed to have and feel like he had over inflation, the lack of control and foresight considering the events that we saw over in Europe as well as in China. that's going to be the determining factor.
I can't wait to get excited about you, Mitch, every 2 weeks now. Is that the data point of the moment now? University of Michigan sentiment?
According
to get the inflation expectations.
Inflation expectations, not the headline number,
Not
which
the
Jay
headline
Powell
number.
said could be skewed to the bearish.
If that's the number we got to watch, I guess that's the number the Fed responds to, then it's important to us all. Futures down by 2.4%. Yields higher by 15 basis points, 342.92. We'll do extended programming for you, Mitch, next week when I'm not here.
Ann Arbor decides. I love the show. Ann Arbor decides.
You like that, Tom? That
I like
works.
that. Ann
That
Arbor
works.
decides.
I like that. This is Bloomberg.
I'll wear blue.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The leaders of Germany, France and Italy are in Kyiv today for talks with President Volodymyr Zelensky. Olaf Scholz, Emmanuel Macron and Mario Draghi travelled together by overnight train in a show of solidarity for Zelensky and his government. The trip comes ahead of an expected recommendation Friday from the European Commission that Ukraine be granted candidate status to join the EU. Russia and China are giving differing accounts of President Xi Jinping's birthday call with Vladimir Putin. The Kremlin says the two men discussed economic cooperation, trade and military ties. China says Xi called for peace and economic stability and made no mention of military ties or increasing trade. The two men declared a, quote, no-limits friendship in February, weeks before Russia invaded Ukraine. European gas prices are soaring as Moscow tightens its squeeze on crucial gas flows to the continent. Germany has called the reductions through the Nord Stream pipeline politically motivated. Challenging Gazprom's claim that the halt was due to technical issues. For months, Europe has feared supply cuts in retaliation for sanctions aimed at Moscow for its invasion of Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is a very soft landing kind of forecast. The Fed keeps talking about neutral being 2.4%, but 2.4% neutral is only if inflation's at 2%. If inflation's higher, then neutral's higher. And so I think the forecast, is still remarkably optimistic.
That was Bill Dudley, the former New York Fed president and Bloomberg economics senior advisor, making that point following the news conference with Chairman Powell just yesterday. This morning, we give back what we got from yesterday. Equities down by 2.4% on the S&P, the Nasdaq down by 2.8%, yields higher by 15 or 16 basis points. We've seen this a few times with the Fed now. Big rally on the day on a Chairman Powell news conference, then we fade it in the days afterwards and fade it hard. This headline, Tom, just across the terminal that I think will interest you and others too. Eni, the Italian energy company, says Gazprom Eni is only providing 65% of requested gas today. This is going to become a problem, Tom, if it continues into winter.
It is. And the spike up here, I looked at it briefly today. What is it, Netherlands TTF, John? Is
seen as the benchmark, sure, Tom, yeah.
Yeah, and the answer is it's not as grim as February 24, 25, 26, but it's getting there rapidly. I mean, it's like, it's June, it's warm. In 90 days, 100 days, it's not, is it?
And rates are going up, potentially at the ECB soon. A few times, Tom, inflation's too high. People are getting squeezed by this.
I'm going to get one question in here with Calum Pickering on Britain before John picks up with his expertise. He's senior economist at Berenberg. Calum, the big difference to me is the wage spiral of the United Kingdom. Does Governor Bailey have a true wage spiral that Chairman Powell does not?
It's a good question. The risks certainly point that way. Labour markets in the UK are tight. There's a job opening for every unemployed worker. The private sector seems to be paying out pretty handsome bonuses in order to incentivize hires and then keep hires. And so the latest data, you're pushing 7-8% year over year. It's totally unsustainable for an economy like the UK. It sort of presumes you need 6% productivity growth year over year for the Bank of England to hit its 2% inflation target. It's inconceivable.
Callum, I want to talk about the currency off the back of this central bank decision in about 10 minutes' time. You've got a pretty original view on why we're down here. I've been asking a question whether an interest rate hike from the BOE today of, say, 50 basis points would damage this currency or not. Some people have got that view. Callum, you don't think this is about monetary policy. You think it's about something else.
I don't think it's about monetary policy. I don't think it's about economic fundamentals. Actually, the UK, for all you can say about it, it's perfectly average as an advanced economy looks. I think what we have is a big Boris factor. You saw sterling weaken considerably once the UK voted to leave the EU. That baked in some economic trouble. Most of it actually didn't unfold. But what we didn't see is as the economy outperformed expectations, sterling rise. We saw sterling move sideways due to Brexit uncertainty. That persisted even as Boris Johnson became Prime Minister. My hunch actually is that if the Conservatives were to replace him with pretty much anyone else, or indeed if the Conservatives were to lose to Labour in any election, then what you would see is sterling move, because the Brexit risks would diminish and markets would actually consider that UK fundamentals and broader political risks are actually, well, boring, I have to say.
Callum, forgive me for asking what might sound like a stupid question, but why would they diminish, regardless of who is in control? Why would it change direction?
That's a good question. Now, Boris Johnson, unfortunately, is like a man straddling two horses that are running in opposite directions. Those two horses are the different parts of his party that want different economic policies. One wants a kind of free market, low tax, low regulation approach. The other wants more government spending, increased welfare state, and that can't be reconciled. So what Boris Johnson seems to do is push Brexit up the political agenda so that he can nominally unite his party, which are all apparently hardcore Brexiteers, which actually I doubt very much. And so once Boris Johnson is out of the way, what you will find is the party will have to decide which economic direction it wants to go. Once it does that, actually the device of using Brexit to try and unite the party is no longer necessary. And then you don't worry so much about an EU trade war. You wouldn't worry about potential consequences for Northern Ireland. You'd even be a bit less concerned about Scottish independence, because that seems to be partly a function and legacy of Brexit.
Callum, if the Bank of England doesn't have a lot of control over the currency because it's ultimately a political question, and they don't have control over inflation because it has to do with Brexit and it has to do with the cost of energy and the global inflationary pressures, how do they decide how to act? How much do they raise rates? How do they use rates as a tool amid futility?
Well, the thing that the Bank of England needs to just try and emphasize, and it's very difficult in this environment, is that even though in real terms the economy seems to be quite weak, it's moving sideways, in nominal terms, actually things are quite strong. It's surprising just how much households seem to be, despite this low confidence, just holding their nose and spending aggressively. So you have this big nominal adjustment upwards in prices and wages. Interest rates need to follow that. The challenge the Bank of England has is, upon now realizing it made a policy mistake last year by overstimulating, much like the Fed and the ECB, the risks are baked into the cake. The hard choice is maybe not between some kind of recovery and a recession, but actually what type of recession we will get. And so what I see from the Bank of England, also with other central banks, is this preference actually to run the risk of the near-term recession. Because if you have that, you get rid of the inflation, you probably start on fairly good fundamentals, and you get the business cycle unfolding. If you don't fix the inflation now and it gets worse into next year, then the recession has to be even bigger in order to recalibrate and recondition inflation expectations. So you always choose the policy which includes the lowest output loss risk. And that seems to be hiking aggressively, even though the risks seem to be accumulating.
So, Callum, about 6 minutes here to go until that decision from the Bank of England. What are you hoping that they do?
I'm hoping that they go for 50 basis points and signal that they will remain aggressive until they see, with confidence, inflation start to roll over and inflation expectations to fall to a level that is more consistent with their inflation target in the long run, and say, unfortunately, we just don't have the tools that can eliminate economic pain as this process continues. But what we will do is, by bringing inflation expectations down and inflation down now, limit the potential pain that could come through unemployment later down the line, because we'll avoid that more dangerous scenario.
Hey, Callum, thank you. Callum Pickering there of Berenberg with some interesting perspective on what he thinks is driving sterling right now. Andrew Sentence, formerly of the MPC at the Bank of England, put this out this morning. He said the MPC hasn't raised rates by more than 0.25% in its 25-year history. A 0.5% rise today would be the biggest rate rise since 1989. That would be a clear signal of how seriously the Bank of England regards the inflation outlook. Anything less, Tom, in his words, would signal a very weak policy response. That's just one view from someone who was pretty hawkish on the MPC back in his days on a Bank of England.
We're all addicted to vectors, getting online and being measured. I don't understand, John, why a given bank can't say 75 beeps and then we'll be wicked data dependent and see what happens. I think maybe that's what Chairman Powell was alluding to.
TK, they're stuck in the last 10 years. They're just trying to get out of this
30.
slow forward guidance mode of 10 years ago. Look
That
at the
worked
ECB.
out.
Look at the ECB.
Forward guidance was dead, John, the day it came out. I mean,
think
it was
so?
It's comical.
Well, I think it's effective, Tom, if you want to try and commit to lower rates in the future, but that works when you've got inflation that you think is too low, Lisa. It does not work when inflation is too high. That slowly movement from the ECB, the S&B's out there, the Fed's already gone, the Bank of England's set to go again.
John, we need team coverage in London. I think that's what
Is that right?
To pick it up, yeah.
Lisa, you signing off on any of this?
I have a lot to say, but we've got 5
sure
seconds.
This is Bloomberg.
A big change from the Fed.
The Fed definitely caught up with the market pricing of rate hikes for the next couple of years.
I think the Fed's forecasts are still remarkably optimistic.
Fed rate hikes just take a really long time to impact the economy.
All these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Oh, we have got a split at the Bank of England from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. TK, it's 25. It's a 25 basis point hike, but that committee is split.
There is the fractious BOE. It is so different from the Fed, John. Esther George, one lone dissent, and this is, am I right, John? 6-3 is sort of an argument.
6 wanted 25, they got it. 3 wanted 50. The Bank of England says it will act forcefully on inflation if necessary. I'm not sure many people would characterize a 25 basis point move, Tom, as forceful this morning.
I look at the statement, John. No statement here on England and Hungary either.
I'm sure he's going to avoid that one today, Tom.
Thank you.
And we can avoid that too. Lisa, sterling, negative 0.9%. Cable, 120.78.
If the Bank of England was worried about where sterling was, it doesn't show in their decision today, because it seemed like, yes, they're trying to recognize the weakening in the economy and the negative print that they saw for a second straight month. But this weakness has got to get their attention in the sterling.
I think we've got to get across to Guy Johnson in the City of London. Guy Johnson, 25, is not getting it done for some people.
No, when you've seen what the S&B has done, when you've seen what the Fed did last night, 75-25 feels like a fairly weak response. But each central bank is dealing with a different set of forces. There are commonalities, there are similarities, but each is dealing with a different set of things that they have to factor in. The language has clearly tightened up, John, so we are going to act forcefully on inflation if necessary. The Bank of England doesn't have a history of going 50. Last time, I had a little aside with the governor after I spoke to him after the last meeting. He was surprised that the market hadn't taken the vote count as signalling a more hawkish intent. We get the same vote count this time round. Maybe they're trying to use it once again to signal that hawkish intent going forward. This is a weaker hike than anticipated by some. It's the hike that a lot of people did, though, anticipate, and it comes with a tinge of more hawkishness, I would argue, added to the statement. You're seeing a little dip at the front end. We've gone sort of circa 2%, just north of 2% on a UK 2-year, back to 199, 198. So a little bit of movement in terms of prices coming off for the UK 2-year. But to be honest, Tom, this is right in the middle of the distribution of outcomes. 25 with a slightly more hawkish tone.
I love the idea here that forward guidance goes. There's an official headline on forward guidance, but I amended it, Guy, to say to act as needed is the new forward guidance. How do you translate that?
We don't know, Tom, is the honest answer. I think they are looking at the data. They're going to act as needed. They will see how the data comes in. They are having to factor in a whole range of other situations here in the UK as well. The fiscal situation has improved for the consumer. The government has added some extra impetus on the fiscal side. That changes the narrative a little bit. The labour market is currently tracking pretty much as anticipated. Wage growth is tracking pretty much as anticipated, but growth isn't. So you're seeing this growth slow down. How those two balance out remains to be seen. Bloomberg Economics currently has the Bank of England tracking with a series of 25 basis point hikes up to around circa 2%. That's where they see neutral is, Tom. But there's a whole range of factors here. I don't think they know. I think they're taking this meeting by meeting by meeting. There is no forward guidance. We'll do what's necessary. We will act forcefully on inflation if necessary.
At 125, I think it's necessary. Inflation, they say, peaking at 11% and rates are at 125. The peak of inflation for the Bank of England, Lisa, won't come until October. That's the Bank of England's view on things right now. When you look at the perspective of the three hawks that voted for this 50 basis point move, and Catherine Mann is one of them again, they see the risk of a more resilient UK demand supply shortfall. Now, Lisa, this is part of the debate that we're having here stateside on the Federal Reserve. What will the Fed need to do? How high will rates need to go to tame demand and get inflation down? And that's the exact same conversation that's taking place on the MPC at the Bank of England.
Yeah, although the Bank of England seems to be taking the opposite approach that the United States does in terms of prioritizing the weaknesses they're seeing in the economy rather than concerns about persistent demand. Guy, if we take a look at sterling right now at 120.76, is this an indictment of the move from the Bank of England, or is it a support of it?
I think it probably is consistent with the idea that maybe some people had priced 50 basis points. It's interesting that the money market, the headline crossing now, is now pricing in 50 basis points for August. The Bank of England has never done 50 basis points. It doesn't do 50 basis points. It is incremental. It does 25 basis points. That's what we're getting at the moment. It is a much more cautious approach. Lisa, I would say there was some risk after 75 from the Fed, from 50, from the SNB, that maybe the Bank of England will be slightly more hawkish. That hasn't happened. Sterling has priced that out. Sterling trades on such a range of factors. I was listening to your conversation just a moment ago with Callum Pickering. There is a whole range of political and fiscal factors that also are being priced into sterling. Sterling is much more muddled. I think if you take a look at the UK 2-year, you're seeing a much more measured response. Sterling is all over the place. Sterling's got a lot to think about. The UK 2-year just moving a little bit. I think this is basically where the bond market saw things going. There is the possibility of 50 further down the road if inflation continues to accelerate to the upside. That's where I would look for my clues. Sterling's so bouncy at the moment, and it's got to factor in the dollar as well and what is happening with the euro.
I'm with you, Guy. Good to catch up, buddy. As always, looking at these forecasts, Lisa, just to re-emphasize them, they see inflation peaking slightly above 11% in October. GDP in the second quarter expected to fall 0.3%. They had forecast just 0.1% growth. But they say there's some upside risk here off the back of a government package, a cost of living package to boost growth and CPI. But Lisa, you put it all together, you've got the prospect of inflation peaking at 11% or above. You've got growth, which is really, really tame right now, put together with 125 on interest rates. I'm not sure anyone knows how to calibrate policy in this world.
Do you think that this is a belief in the Bank of England in transitory, that there will be a natural rolling over that won't come from their dampening demand with a higher and tighter monetary policy? That's going to ultimately become a question. How does inflation roll over if it's not coming from the monetary policy transmission mechanism?
Let's get to Jeremy Stretch on that, the head of G10 FX strategy at CIBC. Jeremy, just first of all, your thoughts on this Bank of England decision from 7 minutes ago?
Well, it's very much as I expected. I did think that the bank would maintain that incremental standard. As you quite rightly said, the MPC have never looked at a 50 basis point move, and to consider going into a historical precedent in a month where there weren't updated macro forecasts included in a quarterly inflation report, I think was always somewhat ambitious. Now, clearly, the external factors in terms of other central banks had amplified market risk that the Bank of England could be a little more forceful. But ultimately, it is still very much a graduated response. And I've just been listening to your debate regarding the impact of inflation versus the growth dynamics. And clearly, I think the Bank of England are very mindful that the growth story is going to prove to be increasingly challenging. And I think that is how we would view it from CIBC. And I think that will certainly temper the reaction function of the Bank of England compared to what the market is anticipating.
Jeremy, tell us the political calculus between the Chancellor of the Exchequer and the Prime Minister with the Governor of the Bank of England as compared to President Biden, Secretary Yellen, and their pressures on Jerome Powell.
Well, clearly, I think from the Bank of England perspective, they cannot influence the fiscal dynamics, but clearly there has been a lot of political pressure on the Prime Minister in order to try and alleviate this cost of living crisis. So we have seen one set of measures at the end of last month, which were worth around 15 billion sterling. So that has provided a little bit of a fiscal impulse. I guess the question is, will the government consider the need for additional policy stimulus before the summer parliamentary recess in July? Because if that is the case, then I think that would amplify the case for 50 basis points come the August MPC. So there is really a sort of an influence in terms of how the fiscal backdrop plays out as to whether the bank will consider it appropriate to hike by 50 basis points. If the government do not put in additional fiscal stimulus between now and the August MPC, then I think it's still most likely that the Bank of England will be looking at 25 rather than 50 basis points at that next meeting. And I think the market, once again, may be rather disappointed.
Jeremy Stretcher, CIBC. Jeremy, thank you. Sterling down at 1%, as Guy pointed out. Sterling in the FX market, so much to think about this morning. Cable, Lisa, 120.60.
I think about what Callum Pickering said of Berenberg just moments ago when he said that perhaps the better option is to, I don't want to say force a recession, but really err on the side of going harder now and allowing that recession to happen sooner, which will actually take away the length of that recession. And I think that ultimately that will be the question that we start asking. How long is the recession that you're expecting? How long will it be if the Fed or the ECB or the Bank of England acts now versus how long will it be if they wait and they act with more tepid steps?
It's not the perfect parallel compared to what's happening with the Federal Reserve and the US economy, but there are slight things, Tom, that rhyme. A couple of them. And here's one. It's the labour market, and it's what the Bank of England is saying about it. A tight jobs market, firms pricing are fueling inflation. And on the labour market, Tom, they said this, no signs of imminent labour market deterioration at the moment. And as we've talked about with regards to the Federal Reserve, how do you tame demand if we don't see unemployment go higher? And that's the uncomfortable part of this for all central bankers.
I just looked at trade-weighted sterling back 30 years. And basically, if they depreciate sterling by 5%, it goes out to new record weakness. And the chart looks like a banana republic. I mean, is basically the UK prosecuting policy understanding permanent sterling depreciation?
There are some people who are, and I stress some people who are worried about an EM-type dilemma for this central bank.
The chart looks like an
in
EM
the UK and for that currency.
Dilemma.
Yeah,
I'm
with you.
I'm
You're
just
not alone
looking
thinking
at the
that.
Bloomberg.
You're not alone thinking that.
Okay.
Futures on the S&P are down more than 2%.
I think it deserves a trip to London.
Do you want to re-emphasize that?
I think the three of us.
Why
I think October 1,
why don't you just
Arsenal
speak directly
Derby.
to management, Tom, this morning and just
I think he is.
ask for that. I think he is too.
I think that's what we're hearing right now.
Bramo, I'll ask again. Are you signing up on this?
Oh,
Is this a trip that we can make, or how do you feel?
I think that
about this?
I feel like it will be something that will be affordable considering the exchange rate.
There we go.
Very well said. Lisa is the sharpest of us all.
Particularly if we avoid a Bramo recession.
120.70 on sterling, down 0.9%. We've had a 50 basis point hike today from the S&P, 25 from the Bank of England, 75 from the Fed yesterday, and more still to come. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The leaders of Germany, France and Italy are in Keene today for talks with President Volodymyr Zelensky. Olaf Scholz, Emmanuel Macron and Mario Draghi travel together by overnight train in a show of solidarity for Zelensky and his government. The trip comes ahead of an expected recommendation Friday from the European Commission that Ukraine be granted candidate status to join the EU. And some NATO members are looking to Germany for cues about how to boost the alliance's defenses against Russia. Bloomberg has learned the allies are considering adapting a new German model in their long-term defense planning. Germany's been identifying units that can be deployed to Lithuania at short notice and placing key equipment ahead of time. It's an alternative to basing new troops more permanently in the most vulnerable member states. The Swiss National Bank unexpectedly increased interest rates for the first time since 2007, shifting away from a battle to tame a stronger currency to focus on inflation. It raised its policy rate by 50 basis points. That is a dramatic move that sent the franc surging against the euro as Swiss policymakers joined the global bandwagon of monetary tightening. They lifted their inflation forecasts and said more rate increases may be needed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
They dropped a critical sentence indicating they're not certain they can do this soft landing. That's an indication that they think they're running the risk of a recession.
That landing strip for a soft landing just gets a whole lot narrower over the last few months. That was Jeff Lacker, the former Richmond Fed president from New York City this morning. Good morning. Here's the price action. We're down more than 2% on the S&P 500. On the Nasdaq, we're down by 2.6. We take away yesterday's rally pretty quickly. In the bond market, yields higher by 17 basis points, back through 4% in Italy. 180 on a 10-year bond, on a 10-year Treasury, up 17 basis points to 345.43. And I want to think about where we've been. The recent high on a 10-year, Tom, that high in the last week or so, 349.65. 349.65 just a couple of days ago.
Yeah, I'm locked on 2-year yield, 3.35%, John. For the 2-year to break out higher to a 3.43% would be a big deal.
It's a big deal, Tom. We had 75 from the Federal Reserve yesterday. We've had 50 from the Swiss National Bank, 25 basis points from the Bank of England and the ECB.
Yeah.
Tumbleweed.
Euro Swissy a 102 to go under a parity would be something. We're not there yet. There's a lot of things moving, a lot of movable parts here, including watching what happens in Japan. Right now, a gentleman from the Republican persuasion and from Arkansas, French Hill, joins us on this odd economy. French Hill, I believe in Arkansas you have a 3.2% inflation rate. You are the kings of chicken. Chicken is in ascendant in this nation because of the price of beef, etc. Can things get any better for Arkansas?
Well, Arkansas consumers, Tom, good morning, are really hurting from high gas prices. We're a rural state, and when I was in private business before I came to Congress, I had many employees in my company that drove almost an hour every day to work, and so gas prices are really hurting our families. They woke up Monday morning in Little Rock to crossing the $5 mark on gas. And so inflation is the top thing I hear about when I'm talking both to small businesses and families. And the second thing, and this is the irony in the economy, you're 100% right. The second thing that's brought up is quality workforce, trying to fill these open jobs in business.
Well, do you fill them by raising wages? I mean, what is the prescription? It's the oddest thing, folks, all this day-to-day crisis we're reporting on, and yet the joy of a fully employed Arkansas, right? How do we solve this conundrum?
Well, first, I think Arkansas is spending a lot of time, and I've contributed in every way I can, both in my business career and now in Congress, to better workforce preparation, better skill training for those coming out of incarceration, those coming out of high school, those still in high school, to make sure they have a path to the pursuit of happiness that's not a college degree. So we've got to do more workforce preparation, and believe me, our state and our counties are doing that every day. Secondly, I think there's a real issue with getting people back to work, and you raise pay, and let me give you a quick example from Central Arkansas. Amazon has recently come into Little Rock with 1.3 million square feet purchased, opening up their major logistics operations, and they're offering about $18 as a starting wage there. So that is also really disrupting that full-time 40-hour-a-week person that's at a starting career. So you're seeing rising wages at the bottom in Central Arkansas.
Congressman, how crucial is it to increase immigration to the United States and open up some of the pathways for people to come in at a time where you're talking about such a labor shortage?
Yeah, Lisa, it's such an important question, and it's been something where America has been stuck for a number of years of trying to do that in a smarter way by doing more merit-based immigration policy, as well as clearing the decks on people who've been waiting 10 years or so with a professional degree waiting for a permanent residency status. So we let about 1 million people in legally in this country every year. It's something that we ought to always look at rebalancing that on the legal admissions. I would think more merit-based admissions would be good to get our our markets more in line with the talent that we need.
Yeah, Congressman, how difficult is that for some of your fellow Republican Congress members to swallow, considering the fact that for so long there was a discussion about reducing immigration or limiting much more substantially? I mean, how much are you representative of the mainstream of the Republican Party versus an outlier?
Right. Well, thanks for that question, because it all centers on the fact that just as we're seeing every day here, record numbers of people crossing the southwest border illegally. And so for years, Lisa, the idea was if we can achieve border security, border control, or as our Secretary of Homeland put it the other day, operational control, which they don't have, that would open up the day, I think, to modify a lot of our internal immigration policies. And that's what we need to do.
French Hill, out of Vanderbilt years ago, I know you still have your Jerry Ford whip inflation now button. You know, as a smart banker guy, that you can't fix inflation. Joe Biden can't fix inflation. Even Elizabeth Warren can't fix inflation. What do you need from Jerome Powell to fix inflation?
Well, Tom, I think he took a bold move yesterday, putting the Fed on record that inflation is their enemy number one right now, considering we have such a surplus of job openings. We have a very strong labor market. So the 75 basis point move I thought was a bold one. He knows he's behind. Tom, you and I have lived through this for many decades. He knows he's behind. He wants to send the signal that the Fed's committed to not letting inflation expectations get entrenched in corporations and pricing. And in the meantime, I think clearly we have to do everything we can to get the supply chain open by unleashing America's power to get people back to work, supply chains open. And this is, as you say, not an easy task. That's why they call it the anguish of central banking.
Tremendously difficult right now. Congressman, always fantastic to hear from you. French Hill there with the latest in D.C. and beyond, Tom, and a focus on this Federal Reserve to do something about inflation expectations. And to the Congressman's point, that's the focus of this Fed. That's what seemed to have spooked them on Friday and Monday too.
Yeah, and John, you look at the Bloomberg this morning, and with the cacophony of central bank news that we have and how it folds back to the markets, I'm looking at the screen, John, and I'm wondering by you get to your property at 9 a.m. or even to the real yield tomorrow, which foreign exchange pair is going to give way?
And which central bank has to make the next move, Tom?
The feeling right now.
I'm calling the BOJ right now, Lisa, Operation Ostrich, sort of with their head in the sand, pretending nothing's going on around them, but a lot's going on around them. That meeting could be interesting.
Especially because right now their hand is being called by a lot of traders. Part of the problem is diagnosing the problem, and Drew Mattis of MetLife wrote in and said that bringing down inflation via monetary policy is going to really charge a massive cost, and that a large portion comes from a lack of supply, not the strong demand. This is the debate. Is it more demand-driven or supply-driven or both? And how do you get monetary policy right if you don't have the correct diagnosis there?
You just got someone right in, Bloomberg subscriber Tom. I'm going to read it out. How has no one mentioned Tom's Kentucky Fried Chicken Colonel Sanders suit as he talks about chicken?
That's why I wore it.
So, that's gold. That's good.
Gold. That's gold, is it?
Beige, actually.
Live from New York City this morning. Good morning. Here's the price action. Yesterday's rally, we take it back. We're down 2% on the S&P 500. On the Nasdaq 100, down by 2.6%. After the Federal Reserve projects higher unemployment, higher inflation, and much higher interest rates too. And some people believe they've got to go a whole lot further. Let's see, the equity market and the bond market looks somewhat similar, with yields higher. Taking back yesterday's move, it's yesterday in reverse. We're up by 15 basis points on a 10-year, 343. 2 days ago, came this close to 350. We're not far off it now, are we? 343 again. Yields building up higher at the front end too by 15 basis points to 334. So we've had a 75 basis point move from the Federal Reserve, a 50 basis point move from the Swiss National Bank, 25 from the Bank of England, and nothing from the ECB. Take a look at Italy. Back through 4% this morning, briefly, then back down again, just a little bit, 391. Yields higher now by just 9 basis points, Tom, because the ECB has a plan to make a plan that could be approved by the Governing Council.
They got a plan, but I think this is, again, important. I said this earlier. I'm going to say it one more time quickly. Spreads matter But what also matters is simple level of Germany, level of Italy, level of Finland, Hungary, the rest of it, and all. And John, I think it bears careful study here, the dynamics. What I see on the screen, I identify one word, flighty. Everything looks flighty right now. Everything looks tentative.
If you want to talk about levels, Tom, 180 on bunds, 350 on 10s on treasuries, 4% in Italy, levels we haven't seen for a long time.
Negative's over, right?
I think it's fair to say negative's over in most places. Though, Lisa, I think we have to say and point out, we're still at negative 50 on an ECB deposit rate. We're still at negative interest rates at the Swiss National Bank. There's still some work to do here.
There's work to do, but a lot of it's being done in the market because people are getting ahead of the expectation for going to neutral or beyond. And what we're seeing, if you want to know the negative yielding debt total, it's $1.6 trillion, down from as high as $18.4 trillion. It is evaporating. Eyes purely on the Bank of Japan.
And Europe moving too. Japan's next. The BOJ?
They got to move.
Really? What do you expect from them?
I mean, not this time, but they have to eventually move away from this because they're buying record amounts of JGBs. They don't have a market anymore. The yen's going the other way, and people are betting against them, and you can see that in the peg. I don't know. That's just my speculation.
Are we calling it a market in Japan still?
No, we're not calling it a market.
We're not, are we? I'm happy we've cleaned that up. Thank you.
I'm done.
That's the cross-asset price action. That's Bramo's rant done too. Let's get you some single names and movers. We can do that with Romain. Good morning, Romain.
Hey, good morning, guys. Yeah, truly a global story. There's what the Fed says, there's what the economic data says, but more importantly, there's what people say here on the ground. When you look at the pre-market action here in the U.S., the 100 biggest volume movers out there right now, all but 2 of them are in the red. A huge reversal, of course, coming off of yesterday's rally. A rally, of course, that really started to wobble as we got closer to the close, as people, I guess, realize that this isn't just about rates in and of itself. It's really about those shaky economic conditions that the CEOs of all these companies have been warning us about now for several weeks. Apple shares down about 2.6% this morning. Pretty much everything in the tech space is lower, as is everything in the retail space. Macy's lower by about 4%. These CEOs have been telling us consumer spending habits are shifting. Just yesterday, we heard from the CFO of Ford. He was speaking at a conference. It got overshadowed by the Fed meeting, but he talked about the idea of that new electric Mach-E vehicle, a really popular vehicle. It has basically been rendered unprofitable because of rising commodity costs. So they're feeling the pinch here. Those shares down to almost 3% here on the day. And then we heard from Elon Musk, and Tesla also is basically saying that they're having to boost the price of their vehicles for the 3rd time so far this year. This is a big issue that could potentially cut into demand, but more importantly, we now know exactly how much is starting to cut into margins. Tesla shares down 4%. Everything in the EV space also down, including Rivian Automotive. Jefferies actually downgrading the sector as a whole, basically saying that the macroeconomic conditions and the inflationary pressures have finally caught up with this space, particularly with some of the high valuations still on some of these names. And if Elon Musk didn't have enough on his plate a little bit later today, well, Tom, he's finally going to address Twitter employees, all hands on meeting a little bit later today. The shares of Twitter are higher, I guess, because people think maybe this is a sign that Elon is going to go through.
Where do we stand on this? I mean, the company still thinks $54, right?
Yeah, and you're $38.75, so that's a $16 spread, deal spread right now. That tells you all you need to know. The max deal spread that we had was 18, so right now the market is betting that this thing ain't getting through.
Romain Bostic, thank you so much. Right now we want to launch it to Troy Gajewski's Chief Market Strategist at FS Investments, with a very clear knowledge of how at times hedge funds take a loss. Troy, right now everyone is taking a loss. What have you learned about alternative and hedge fund investment performance given a legit, ample bear market?
Well, look, I think if you look at alternatives broadly, it's such a wide definition. And if you look at strategies like senior secured commercial real estate debt, having very strong years, global macro funds finally taking advantage of Fed tightening and obviously broader dislocation, more market neutral strategies performing well that can take advantage of volatility. But obviously, if you stayed too long in go-go growth and got a little carried away in VC and PE, you're feeling a tremendous amount of pain this year and giving back 2, in some cases 3 years of return. And you often see this, right? The hottest trade, whether it was the late 90s in tech or whether it was energy and commodities from really 2004 through 2011, when those excessive periods of performance unwind, you can have tremendous givebacks of performance. But the good news is most alternatives are performing well. in an environment that's very, very challenging for fixed income as well as equities, to say the least. And unfortunately, there's more than likely more pain to come in broader markets.
Troy, typically when these kind of things burst, if you do indeed believe it was a bubble bursting, it takes a long, long time to play out.
Yes.
Years and sometimes decades. Is that what you expect to see here? And in what parts of the market do you expect to see that?
Well, look, I think it's pretty bold to say we're in for another lost decade. Clearly we've had other galactic mean reversion periods between financial assets and the real economy. The 2000 to 2010 period would be the most notable. But we're certainly in for at least the last several years in broader asset classes after, 13 years of a historic bull market and a 40-year bond bull market. But clearly tech continues to be at the crosshairs. Anything, it still has relatively high PDEs. Fortunately, price to sales have come down dramatically and have really normalized at light speed. And that's one of the factors in this cycle is it's not just the magnitude of the moves, it's also the speed. But that's one area wherever you don't have very attractive cash flows, whether it's still based on, revenue growth as opposed to really hard cash flow growth, those places are going to be challenged for multiple years. And, the technicals just don't look very encouraging anytime soon. So, don't be a hero. Don't try to average down into oblivion in the sectors that continue to suffer.
Don't be a hero, but can we write the obituary on instruments that really were the products of negative interest rates? Some people would argue that fueled the Bitcoin rise that you believed in for a while and you were talking about, right? I mean, can we write the obituary now on that crypto asset?
Oh, no, look, I think Bitcoin's still, right, over the medium to long term, it's one of the additional ways that you can now hedge government profligacy risk. And in the short and intermediate term, obviously the Fed is tightening money supply. We already have negative M2 growth, despite the fact that the Fed has just recently moved aggressively and yet has yet to drain the balance sheet. But over the medium to long term, it's really hard to bet against government profligacy. So even though we're going through a violent bear market, a recalibration of price, over the medium to long term, we'd still expect it to benefit from those really multi-decade trends. But certainly, at least in the short term, it's hard to get excited about any asset that doesn't have tangible cash flow behind it. And you're much better off being in the senior part of the capital structure, particularly in senior secured commercial real estate debt or in strategies that can take advantage of volatility now, as opposed to being preyed upon by it.
Troy, good to hear from you. As always, buddy. Troy Gajewski there of FS Investments. Just getting this news from the ECB, from the team over in Frankfurt, Germany. I'll read you the first paragraph. Bond buying under any new anti-crisis tool from the ECB would probably involve selling other securities so purchases don't upset efforts to curb record inflation. This story, according to people familiar with the matter. Countries that benefit from it would have to meet certain conditions to avoid concerns the ECB is financing governments outright. So that's going to be interesting to see what those details and conditions actually are. At the very bottom of the story, I think for market participants is a very important line. Reads as follows. Flexibility may also involve front-loading reinvestments, meaning the ECB could buy new bonds before older securities mature. Tom, that's the part of this mechanism, this effort, that I imagine is getting people's attention in the bond market as the Italian yields roll over. And now positive just 5 basis points. So the high of the day was 390.95 on an Italian 10-year, and right now we're at 386.
Jenna Randall and Alessandra Migliaccio, John, have written the oddest fixed income story I've ever seen. You read the first paragraph of this story, and it literally looks like foreign exchange sterilization, except I'm going to invent the phrase bond sterilization. That's how contrived this is. Not silly, that's not the right word, but this is an exceptionally odd story of this desperation to come up with a new mechanism.
I remember the securities markets program in the crisis, Tom, in the Eurozone debt crisis, and I believe that was sterilized too to begin with. So I remember going all the way back then. What's interesting about this, though, Tom, is they're trying to tighten financial conditions at the same time they're trying to contain what happens on the periphery. And to trying to do those two things simultaneously, Tom, and that's what gets my attention. That's the real difficulty at the moment.
They've got a 17 billion euros, $18 billion gross flow, 12 billion of which, let's call it 60, 70%, is from the core countries. Let's call those the successful countries. They need to bail out the peripheral countries, particularly down, I believe, south. I'll let you decide how much I should insult the Italians right now, John. But the bottom line is they want it both ways. They want to buy and sell
I'm not sure what's
at the
going
same
on.
time.
He's upset in London, and now I'm in charge of how upset the Italians are.
Yeah, you know.
So take us out, John. Let's go.
TK, you own that.
Randall and Migliacci have done a great job on this. It's a tour de force of confusion.
Okay. Up 18 basis points on a 10-year.
It's an anti-crisis
in the US.
tool.
346.39.
I was talking
Equities
about my
down
suit.
by 2%. Your suit is an anti-crisis
My
tool.
suit is an anti-crisis tool.
You think that's scaring the Italian bond market
It
this
is.
morning? Scaring the bond bears from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The leaders of Germany, France and Italy are in Kyiv today for talks with President Volodymyr Zelensky. Olaf Scholz, Emmanuel Macron and Mario Draghi travelled together by overnight train in a show of solidarity for Zelensky and his government. The trip comes ahead of an expected recommendation Friday from the European Commission that Ukraine be granted candidate status to join the EU. Russia and China are giving differing accounts of President Xi Jinping's birthday call with Vladimir Putin. The Kremlin says the two men discussed economic cooperation, trade and military ties. China says Xi called for peace and economic stability and made no mention of military ties or increasing trade. The two men declared a, quote, no limits friendship in February, weeks before Russia invaded Ukraine. European gas prices are soaring as Moscow tightens its squeeze on crucial gas flows to the continent. Germany has called the reduction through the Nord Stream pipeline politically motivated, challenging Gazprom's claim that the halt was due to technical issues. For months, Europe has feared supply cuts in retaliation for sanctions aimed at Moscow for its invasion of Ukraine. The Bank of England has raised interest rates for a fifth straight meeting. The 9-member Monetary Policy Committee voted 6-3 to increase the benchmark lending rate by 25 basis points to 1.25%. A minority of officials maintained their push for a move of double that size. Policymakers led by Governor Andrew Bailey hinted that they may join a growing global trend for larger hikes if inflation continues to soar. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
There's a chance that we are already in a recession. And so if we are in a recession or we're close to a recession and the Fed pushes on this more, and then we find that all of a sudden we have a decline in asset prices like stocks did in '87, then if the Fed reverses course, they're going to look like they're weak on inflation.
Scott Minerd there, highlighting a big problem. The Guggenheim CIO from New York City this morning. Good morning. Equities down 2.4% on the S&P 500. We look like this on the Nasdaq, down by almost 3, off by 2.9%. Yields higher by 20 basis points on a 10-year and getting closer and closer to 350, 348.13, Tom, on a 10-year Treasury this morning. Troy Gayeski followed up his interview with this email. Great to see you. Wish I had time to give a shout out to TK's triple leverage cash ETF. It's having a great year, Tom.
It is. You know, I really want to.
It's the only safe place right now, TK.
Well, we're doing a mid-year review. We're right now we're carefully monitoring.
You might allocate
the
some
volatility.
of that cash.
No, I just there's a lot of pressure on that, but we may. It's been so successful, we may go to a 4-pull leverage, but we haven't gotten there yet. It's a June 30 decision. We're not there yet. Our decision right now, Kriti Gupta on the dollar. What do you have, Kriti?
Well, we're just going to talk about the trade-weighted dollar here because as we talk about these interest rate differentials that are really boosting the dollar, strengthening the dollar, let's talk about the other currencies that are involved here. Remember, a lot of commodities, oil, food prices, wheat contracts, all priced in the dollar. So as you see the surge, really a reversal, almost a V shape as shown in today's chart of the day that you are starting to see from the decline in 2020 and arguably half of 2021. The big question is what does this do to exports, as well as you have a weakening euro, a weakening yen, a weakening cable rate, I should also add. But also remember you have some competition in Asia between the Chinese renminbi, the Korean won, the Japanese yen, in terms of just the amount of exports that can be offered to consuming nations like the United States. And of course, that purchasing power as shown for our radio audience by the surging dollar that's that's going to be a significant part of the equation. It's not just about the Fed, it's about trade as well.
It is. That's a great chart. And on radio, it's real simple. Up we go, and up a couple years ago, but you really wonder at what gap up in dollar if we're to break out of DXY at 105, where things become disruptive internationally. There's so much news flow. We've leapt forward from the Fed meeting yesterday, which we must remember was absolutely historic. I remember a conversation I had with David Malpass, now at the World Bank, and Alan Meltzer of Carnegie Mellon years ago in the uproar of the great financial crisis. Guess what? Yesterday afternoon was like that. To give us perspective here, and particularly to give us Chicago perspective, Anna Wong joins us. She is Bloomberg chief U.S. economist. Anna, I look at a glide path of inflation that's not a smooth curve. It's not all the rose-colored glasses that we heard from Chairman Powell. It is down from 8% to somewhere of 4 or 5. And then there's exceptionally heavy lifting to get inflation back under 3%. Do you model, and does your team model, that they can get back to 2%, or is 3% inflation the modern era's new 2% inflation?
Yeah, Tom, economists look at this trade-off called the Phillips Curve. This is the trade-off between unemployment rate and inflation. And we have been saying that that curve is very flat. So in order to get inflation down by 100 bips, let's say it's at 3, and you want it to go down to 2, the trade-off would be about, you will need about 3 percentage point increase in unemployment rates to achieve that. So it's very costly.
And it's very costly, and it comes at the expense of the economy. One thing that you talk about was that it was unlikely just a couple months ago that there would be a recession before the end of next year. Now Bloomberg Economics is modeling in a 75% chance of just that. How soon could that recession come? I mean, this is really something that people are talking about in tandem with what it would look like.
Yeah, so we got to that 75% probability last week. That is before the surge in U.S. Treasury 10-year yield, which is one of the variables that entered into the model. So now with Treasury yields, the 10-year rate surging by almost significantly since last Friday, I think the model would have said that. If we were to run it now, a significantly higher percentage probability. And I personally think that the recession would be quite shallow and short because we don't see the kind of terrible balance sheets going into recession, and usually a financial distress could amplify the downturn.
In the core equation of GDP, Anna Wong, is the next recession coming? And I think people understood yesterday. I really don't believe in it. There was a guy, Samuelson, years ago, Anna Wong, I believe he was at some East Coast school, who said there's like 9 recessions predicted. Anna, it's simple. We're going to have a buoyant domestic economy, and maybe international dynamics lead us to negative GDP. Should I be afeared of too many imports into America?
Well, imports constitute such a small percentage of U.S. GDP. It's not even, a key driver. Accounting-wise, yes, it would lead to a negative GDP. But in that case, I'm sure the NBER folks who are dating recessions won't classify a import surge-induced negative GDP growth as a recession.
There you go.
Anna, thank you. Wonderful. Anna Wong there of Bloomberg Economics. And Tom, this kind of points to what we were talking about in the last 24 hours, that Atlanta GDP now forecast, which is negative.
Well, I'm going to go back to this. There's characters of recession. In the 80s, we had a double recession right back together. 73, 74, John, was ugly. I mean, that was a little bit that I remember of it. But John, I mean, they're all different. There's a growth recession. As I mentioned earlier, there's a Bremo recession.
We started the program this way, Lisa. You have to think about where the leverage is. And we're told continuously that it's not on household balance sheets, that corporations are stronger. If that's the case, what does this one look like if that's what we're getting?
And that's why Anna Wong and many others believe that it will be a shallow one if we get it, and the likelihood is that we will. I just want to point to something that Jay Powell was talking about yesterday about the war in Ukraine by Russia and how that was really one of the major factors in inflation coming in faster than expected. Look at what's going on with European gas prices right now.
I know.
Up 24% on this idea that perhaps Russia's going to cut off some of the supplies.
That's natural gas.
That's natural gas, correct. How much is this really the difference difference between how deep the recession will be and how soon it will happen.
We've seen this the last couple of days now. Gazprom seemed to be starting to cut back, Tom. Heard it from Annie a little bit earlier this morning, didn't we? Providing 65% of requested gas today. That's the Italian energy company.
When was the last time we quoted this? Granted, it's weaker today, but dollar ruble is strong Russian ruble with all that cash flow coming into Mr. Putin. I mean, it's been widely reported. Maria Tadeo with photos today of 3 Western leaders on a train to Ukraine, and we got a little bit going on, John. I think we've underreported this, but this war is still front and center.
The European economy is going to squeeze, Lisa, and continues to get squeezed. And the ECB hasn't even started to raise interest rates yet. Have you seen this move in the bond market this morning? Yeah. German 10-year. German 10-year is absolutely flying. Got a 10-year now, up 24 basis points, pushing 190.
And you're looking at some of the highest levels that we've seen going back to 2014, a game changer. And how does this factor into an economy that's getting squeezed for non-monetary policy reasons?
Perfect guest next. Andrew Sheets of Morgan Stanley. Looking forward to that. He joins us shortly. Futures on the S&P. We're down more than 2%. This is Bloomberg.
A big change from the Fed.
The Fed definitely caught up with the market pricing of rate hikes for the next couple of years.
I think the Fed's forecasts are still remarkably optimistic.
Fed rate hikes just take a really long time to impact the economy.
All these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. A moment in history for economics, finance, and investment, and we see it on the Bloomberg screen. John, so many central banks acting, and what I see massively on the screen, tick by tick, is uncertainty.
Yields are absolutely flying, Tom, and they're flying higher. Even as we talk about lower growth, maybe even recession, yields are heading in one direction. That's up. You've got bund yields higher. You've got the 10-year Treasury higher, pushing 350. You've had a hike of 75 basis points at the Fed, 50 at the Swiss National Bank, 25 at the Bank of England. And, Tom, more still to come.
Yeah, more still to come. And, John, what is so important, folks, is we're not even discussing stories of import that are just pushed off the radar by this central bank derby. That ECB story from Jenna Randall out an hour ago, John, was the single oddest, desperate bond story I've ever seen. ECB, Lagarde, in search of an anti-crisis tool.
And they've got a plan to make a plan, Tom. They want to somehow contain Italian bond yields at the same time as increasing interest rates and tightening financial conditions. It's going to be really hard for them. It's going to be really, really tough.
Lisa, you mentioned the shocks that are out there, including natural gas to the moon and essentially Tunisia with elements of the Jasmine Revolution. Tunisia shut down this morning.
And you had also that fire at that plant, the export facility from the United States that exported gas to Europe, which also caused a spike in natural gas. All of these highlighting the real worry in yesterday's meeting with Fed Chair Jay Powell, where he was talking about chasing gas prices, chasing oil prices, that even though this is not within their control, it is in the headline number, and headline number creates expectations, and they have to fight that.
And John, even in boom England, and I mean this with huge wage growth, as we heard from Caitlin Pickeram, corporations are adjusting. Out moments ago, Kroger, the U.S. grocery store chain, raises their view from a 375 up to a 385. John, the oddity here of measuring our gloom against what's coming out of corporations' mouths is fascinating.
And compare it to how consumers feel, Tom. We talked about that a lot. Consumer sentiment is deeply, deeply negative. Gas prices are very, very high. And the price of everything in the last 12 months, the price of a lot of things, Tom, has gone up. Think about central bankers right now. They're looking at the labour market, and from their perspective, they see strong labour markets. Maybe not Europe, but the UK and the Federal Reserve, they're saying the same thing about that, which raises this question. How high do rates need to go to contain inflation? The elements of inflation that they can actually control. And, Tom, that debate is wide open still. Bill Dudley thinks much higher. Others think we might already be there.
Yeah, I mean, and Dudley was extraordinary yesterday. I hope folks, particularly Global Wall Street, go back and watch the Bill Dudley interview in entirety. John, the data check, I don't know where to begin. I'm going to try Euro Fragile 103.94.
Start like this. Yesterday, upside down, in reverse. Equities shaping up as follows. We're down 2% on the S&P, on the Nasdaq 100 down by 2.3. Yields higher by 16 basis points. The recent high, very close to 350. We're close now, up 16 basis points to 344.85. And Europe, we have a problem. We have a problem in the FX market. Euro dollar 103 again, 103.91. We're negative there, 0.5%, Tom.
Sterling off Bank of England 121.36. We dive into it with Andrew Sheets. He's chief cross-asset strategist at Morgan Stanley, really coalescing in mathematically, statistically, as is Brown University math, of what the total, the whole view is. And the summary, Andrew, is simple. Morgan Stanley thinks like Joe Stiglitz, growth matters. Tell me why growth matters.
Yeah, thanks, Tom, and it's great to be here. So I think this is a backdrop where the Fed is shown that it's going to have to be very data dependent over data that it doesn't necessarily have a great deal of control over, because the actions that it's taking now, as you discussed earlier on your program, are not necessarily going to do anything about gasoline prices, airfares over the next month or 3 months that are driving these inflation surprises that Chair Powell mentioned. So you have a situation where I think the Fed is somewhat captive to the incoming inflation data that matters a lot. And then the growth outlook is also very uncertain. I think the Fed acknowledged that uncertainty. I think, we see it in our own forecasts where there is a lot of different data pointing to different trajectories for the economy. Where we come out of all of that is to try to be relatively defensive, to try to keep positioning light as you continue to have a number of cross currents going on here.
Andrew, it's amazing to me that we talk so much about the prospect of recession, and yet we've hardly talked about downgrading earnings. I had Pinky Chatter at Deutsche Bank on yesterday. I think it was the first time I'd spoken to someone on Wall Street, an equity strategist who was actually cutting their earnings expectations. First time in a while. Andrew, I know that you and Mike Wilson have been on top of that story too. What do you make of that? That we haven't had the warnings from corporations, we haven't seen the street downgrade earnings in a way that would match this recession conversation?
Yeah, Jonathan, I think this is what's so fascinating about what's going on is I think that's exactly right in terms of the next thing to focus on. When we think about the market, and particularly the U.S. equity market, my colleague Mike Wilson thinks the market has generally adjusted to the rate rise that we've seen, roughly. What it has not adjusted to is earnings downgrades, which you usually get when you've had this sort of reduction in financial conditions, when you have had these sort of risks around growth, when you have the declines in PMIs that we think are likely. So I think that's now where the rubber meets the road. There is a scenario that's more positive than ours where the companies are able to continue to earn profits and hit those consensus numbers. And in that case, the market could stabilize around current levels. If they cut earnings as we expect, then we still think that there's some downside risk here and it's too early to try to enter the market.
Andrew, which is the reason why perhaps you're looking elsewhere. I was kind of surprised to see where else you're looking. Japan? Why? Based on the fact that you've seen that the yen depreciate so significantly, and a lot of people expect that they will eventually, the Bank of Japan will eventually have to follow its fellow developed market central banks.
Yeah, that's a fair question. So it's pretty apparent that every major global equity market in the world has its own particular challenges. We just discussed the U.S. Europe has active ECB hiking. It has the war in Ukraine. China has the challenge of a zero COVID policy. And Japan also has very easy central bank policy that's increasingly disconnected from the more hawkish policy elsewhere. But we think for the moment, that's one of the better challenges to have. We think the Japanese market is not priced for the yen depreciation that we've seen so far. We think that if the yen were to stay around 135 or move higher, move weaker, that would result in earnings upgrades at a time when other regions could be seeing earnings downgrades. Japan has derated significantly. It's not nearly as expensive versus history as some other markets are. And we do think that the Bank of Japan will stay patient a little while longer because the inflationary pressures in Japan not only aren't as severe right now, they've been so much lower for so much longer than the U.S.
So when you talk about creating some sort of ballast to the portfolio, I understand the bet on Japan to some degree. However, there's got to be some bigger pool of securities that have to come from a place like the United States or like Europe. If you don't like stocks right now because of that earnings uncertainty, how much conviction can you have around the long bond at a time when the Fed is going really aggressive?
Yeah, no, I think that's one of the challenges. I mean, I think this is an environment where overall exposures, gross exposures, investors should be trying to keep those lower and to stay more liquid, because as we've just seen over the last 24 hours, the price action can be extremely volatile. It can be extremely hard to manage those risks, and there's large amounts of uncertainty. So I think keeping lower exposures generally in this environment makes a lot of sense. I think it's trying to look for kind of relative value, putting more relative risk into relative value strategies than directional strategies at the moment, as I think we are seeing a number of instances where relative value is working despite the volatile environment. And then it would be something like oil, which is an asset that we like, where you have an inflation hedge that pays you quite well to hold it, given how backwardated that oil curve is. And so that's a way to generate some yield while also providing some protection.
Andrew, just to clarify, 3,400 is still the number for you guys on the S&P?
Yeah, that's where we think the risk reward starts to look more compelling.
Okay, Andrew Sheets there at Morgan Stanley. Some downside still to come then for the team over at Morgan Stanley. Andrew Sheets there, working closely with Mike Wilson, of course, at Morgan Stanley too. The equity market looks like this. We take back yesterday's rally. We're down about 1.9%. We take back a lot of it anyway. On the Nasdaq 100, we're down by 2.24. Just sit on this move in the bond market a moment. We're up 16 basis points on a 10-year Treasury to, let's call it, 345. On a 10-year bond, we're up 19 basis points to, let's call it, 182. And in Japan, we're at 25 basis points and going nowhere. Tom, this bond market has sat out the whole sell-off worldwide in Japan because the Bank of Japan is just sitting on it, keeping it there. How sustainable is that policy going to be?
It's absolutely not. There's
as
not
the world
one,
around them
whatever
goes in
anybody,
the other direction.
John, whatever anybody thinks, no one thinks it's sustainable. At some point, that experiment, and frankly, cultural experiment, behavioral experiment will end. And how it ends, it's not my job to pontificate on that. I will say, John, this screen is original I'm looking at. I don't want to be gloomy. It doesn't harken back to 08 or 07, but it's amazingly flighty. And what I would watch right now, John, is euro dollar 103.94 with some key mid-May weakness to confront here with a move down.
And just a reminder, Lisa, the ECB still hasn't made a move either on interest rates.
Right, although their hand is being forced and they're coming out pretty aggressively with
big
guidance.
Big time. Euro dollar 103.94. Coming up, Leslie Vinja-Murray, the head of the US and America's program at Chatham House. Looking forward to that. Equities down from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The House Committee investigating the January 6, 2021 insurrection of the U.S. Capitol will focus today on the pressure then-President Donald Trump put on Vice President Mike Pence to block congressional certification of Joe Biden's presidential election win. The panel will hear Trump was repeatedly warned his plans were illegal. The hearing may include testimony from Trump aides that when Trump learned rioters invading the Capitol were calling for Pence's lynching, he responded by saying Pence, quote, deserves it. Some NATO members are looking to Germany for cues about how to boost the alliance's defenses against Russia. Bloomberg has learned the allies are considering adapting a new German model in their long-term defense planning. Germany has been identifying units that can be deployed to Lithuania at short notice and placing key equipment ahead of time. It's an alternative to basing new troops more permanently in the most vulnerable member states. U.S. authorities are sailing the $325 million super yacht they seized last week to Hawaii. The yacht is linked to Russian billionaire Suleiman Karimov. It's a big win as the U.S. looks to confiscate Russian assets and push oligarchs for their country's invasion of Ukraine. The 348-foot Amadea is now sailing under an American flag and manned by an all-new crew. South Korea will expand the role of nuclear energy in order to meet its climate target. President Yoon Suk-yeol's new government said today it will increase the portion of atomic power in the energy mix to meet its emissions reductions goal. The country will maintain the target set by the previous administration to cut emissions by 40% by 2030. Yoon, who took office on May 10th, touted nuclear energy throughout the campaign. Global News, 24 hours a day. I'm Ritika Gupta. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
This is, a big change from the Fed in going from, magical thinking in terms of their earlier projections to a little bit more realism. But the challenge really lies ahead.
That's a new one. Magical thinking. Looking at the Fed's forecast, Jeff Rosenberg there of BlackRock, a portfolio manager from New York City this morning. Good morning with Tom Keene, Lisa Abramowicz and Jonathan Ferro. Futures are down by almost 2% on the S&P, off the lows, but still negative 1.9%. On the Nasdaq 100, down by 2.25. Yields are much higher this morning, up 15 basis points on a 10-year, 343.69. It's not just the US, it's Germany too, where yields are higher by 18 basis points on a 10-year, Tom, in Germany, 181. Do you remember when it was negative about 2 minutes ago?
2 cups of coffee ago.
End of the year, I think it was negative 17.
Yeah. Euro Swissy, Swiss National Bank makes a move. 103 becomes a 101 this morning. Stronger Swiss franc, I should say. This is a joy and well-timed. Leslie Vinjamuri joins us right now, head of U.S. and America's program at Chatham House. And Leslie, off our radar has been Ukraine. I mean, there's just been so much news flow in economics, finance, investment. I've underreported it. I've underread that. Odessa, through the Black Sea, past Istanbul, and down to Tunisia is 42% of the wheat that Tunisia brings in. And they're not doing that with Ukraine. And the price of wheat in Ukraine has gone from like a 250, 270 level up to a 400 level as well. The wheat and food ramifications of a Tunisia shutdown this morning, it's here and now, isn't it?
It absolutely is. And of course, many people have been forecasting this for a long time. But the political pressure, it comes from those who are actually supporting Ukraine in the West. The impact, some of the greatest impacts are coming from a very different part of the world, across Africa, across the Middle East. People who are relying on food that are suffering those rising food prices, but that mobilization isn't getting channeled through our governments that are making the decisions. So now I think we've been slow to respond. There are many people who are saying we've got to have some sort of effort to try and get the grain out of Ukraine and Russia, to create some sort of exception for that, to really ameliorate what could be very devastating political and economic impacts.
I saw a bar chart of U.S. cash commitment to Ukraine versus others of the allies. I was sort of thunderstruck at the size of the U.S. commitment. In the next 6 months, do the allies get their act together, not only about the war and ammunition, but also about the food crisis, which for Tunisia is here and now?
Well, I mean, there are a lot of things in that. I mean, the first thing is that there is concerted effort. The U.S. is always going to spend more, but there's a lot of division across Europe on this. I think you see the U.K. really strongly aligned with the United States. Germany is obviously a little bit more torn internally.
Even Scandinavia,
this is a big change. Even Scandinavia, those numbers are lower. But on the food question, there is a sort of how do you get those grain exports, those commodities out of Russia and Ukraine, and that's got to be an international effort. That means probably working with Russia. That's a very complicated set of mechanisms that again many people are working on. Very controversial, but incredibly important and grave risk. Not only for food insecurity, many people across the global south facing dire situation, but also, as we've seen, for the political impacts of that.
Leslie, you talk about the U.S. leading, and there has been some question about the U.S. leading with a president largely thought to be a one-term president, increasingly low popularity ratings, especially as the inflation rate surges, and the expectation is increasing for recession. Who leads the party forward? Who is going to be the main compass of leadership over the remaining 2 years and beyond in terms of the Democratic Party?
Well, this is a concern, but you could argue that a one-term president, if that's what President Biden faces, I think it's very far from certain. 2 years is a very long time in U.S. politics. A one-term president has the ability to take some brave and bold measures, probably not through Congress. But I think there's a lot to play for here. And as we know, we're watching the January 6 hearings. We're watching how Americans will respond to inflation. Whether they will attribute the price rises that they're feeling to the war in Ukraine, I think is a very big question, and I think there's a lot of division on that. Again, these are deeply political questions.
But Leslie, from a deeply political perspective, is it in the Democrats' best interest to really make a conclusion? You said that it's very unclear whether he's a one-term president. We're talking about popularity ratings that we have not seen for a long time in terms of how low they are, and inflation that is at a 40-year high. Do you think that there is a feasible path for him getting reelected? And if not, isn't it logical to try to get the other person up and running?
Again, I think that politics is a question of alternatives. A lot will depend on who the Republican Party put forward, if they take the House, if they take the Senate after the midterm elections, what measures do they take? How does the American public respond to a Democratic president who is impacted by a Republican Congress? That will change how people feel. But to your broader question, of course, President Biden needs to have a very strong team around him. He's continuing to build that, to bring new people into the administration. We're seeing some of those announcements recently. But I think that this is a president who's, who's facing a very difficult domestic situation, coming out of COVID, coming out of an extended war that's gone on for many months, that's hitting and driving forward inflation, that's driving forward potentially an economic recession, not only here but across the world. So a U.S. polity that, as we know, is deeply polarized. A lot of that polarization is driven very actively by those who seek to sort of undermine this president and his agenda. So there's a lot, I think, to play for. Very difficult to predict what will turn out. But I think right now the key thing is responding to this war, responding to the problem of inflation, and responding to the multiple domestic concerns that are dominant domestically in the U.S. and doing it in partnership with Europe, but really trying to build on those global questions, build that partnership far beyond Europe. That's arguably one of the biggest challenges. How does this president work not only with America's traditional partners, but really to expand the international support for measures that will really turn the needle for so many who are facing very dire circumstances on a daily basis.
Leslie, thank you. Leslie Vinjamuri of Chatham House in New York, I'm pleased to say. Tom, at the start of the year, I think we both said that the calendar might be on the president's side, that things could get better as the year grew older. I think that's changed over the last few months. There is a real feeling now that things get worse before they get better, particularly going into the midterms later this year.
124 and Brent crude down to 117 is where we are right now. And I would just suggest, John, that for the president, for domestic politics, it is just about a gallon of gas. That may be odd for our international audience to understand, but as you heard from French Hill, they drive in Arkansas.
The bills are headed in the wrong direction, Lisa, and wages aren't keeping up.
And that's ultimately going to be one of the main driving issues as people head to the polls.
Futures down 1.8% on the S&P 500. You're opening about 1 hour and 4 minutes away. Equities down about 1.9% on the S&P, on the Nasdaq down by 2.2%. Waiting for some economic data in the United States of America. Jobless claims coming any moment now, which is Mike McKee. It means Mike McKee has ran from Washington, D.C. to New York to jump into the studio.
He's amazing.
It's just incredible, Tom. Lost for words. Morning, Mike.
Good morning, John. Well, we're back in that situation where every data point counts and bad news is bad news as we try to figure out whether the Fed does 25 or 50 or 75 at the next meetings. And we've got some numbers here that will be interesting to the Fed, but don't look like they're going to make a lot of difference. The jobless claims numbers come in surprisingly unchanged from from last week. They're 229, initially reported as 229 last week. It's actually was 231, so you end up with a decline in jobless claims. The Fed is looking to see if that's a harbinger of, if claims are a harbinger of softness in the labor force. Apparently not yet. Housing starts and building permits, Jay Powell said yesterday, the Fed's rate increases are having an impact on housing, and boy, did they, down 14%, 14.4% last month, although the prior month was in April revised from a 0.2 decline to a 5.5% gain. So maybe we're about 9% difference. Building permits, though, fall 7% after a 3% decline. So building permits are falling. It does look like builders are starting to pull back, and we did see that in the builders survey yesterday. Finally, we've got the Philly Fed number out there. People watching these regional Feds to see how business is going around the country. Not so good in Philly, down 3.3.
Bundle of joy today.
Yeah, I'm a bundle of joy. Which is down from 2.6 the month before. So problem for the Fed in that the Philly Fed suggests manufacturing lightening up, housing starts certainly being affected, but still nothing in the jobless claims numbers. A lot of, as somebody put it today, anecdata that companies are starting to announce layoffs, but at this point, we're not seeing a lot more people who are looking for work and out of a job. Let me just quickly look here. Number of employees in the Philadelphia Fed survey goes up. So go figure.
There we go. The losses in equities stick, Mike, so not much change in there. We're down about 1.9%. Something does fade, though. It's the gain in the Treasury yield, up now by just 12 basis points to 340. Bramo, those housing starts, that's pretty ugly. You get the feeling that's the start of more to come here in that part of the economy.
This is one of the fastest moving markets I've ever seen in terms of a 6% mortgage rate. What does that do to demand when you look at the all-in costs and how unaffordable housing already is? How much do we revert back to bad news being good news for the markets, because it signals that you're getting that weakness that could potentially prompt the Fed to stop raising rates as much and as quickly as they seem to be forecasting? Housing market is a key one, especially given where mortgage rates are and especially given the run-up in prices that we've seen, John.
Try selling that one, Tom. At least I think that's such a hard sell for people. The Fed backing away because the economy is rolling over and inflation is going to persist.
Well, not necessarily backing away, but not raising rates as quickly as some people are projecting. And this is the reason why some people actually are still holding on to conviction with risk assets, because otherwise, what's the wager if the Fed's going to really go to 4% by the beginning of next year?
Yeah, that whole debate about September and the pause, Lisa, I'm with you. I hate the idea that bad news is good news. You've got to think about why the Fed would have to back away. If inflation's coming down more quickly because you get this massive supply side response, without a doubt, that's bullish this market. But if you've got to back away, Tom, because the economic data is dreadful and they're going to have to tolerate much higher inflation for longer, that's a problem.
Michael McKee with a rude question yesterday. Let's review that right now. Nominal versus real data. And the chairman sort of stumbled over your study of nominal versus the real economy, how the economist should go about this. Help me here. If we have tepid real GDP, but then you overlay on substantial inflation, that's a high animal spirit for the country. Is that factored into the analysis right now?
Well, it does, because the Fed is supposed to target headline, and headline numbers keep getting pushed up by things the Fed can't control. The Fed would like to look at the core rate of inflation,
but they can't.
And they, in terms of trying to figure out what policy they'll make, they do. But the problem then becomes, what do they say to the average person who's still filling up their tank and paying $80 a tank, and then their confidence level goes down and they stop spending money?
John, I thought once again McKee was ignored by Chairman Powell.
Oh, I thought you asked him a zinger. I thought it was such a good question.
It's a trend.
Mike, it was such a good question. What did you make of the answer? Just briefly, Mike. You asked him basically whether he'd keep chasing headline inflation, which ultimately was being fueled by what happened with crude, and I think you were pretty blunt about it. You're going to chase the oil market here.
Yeah, and he said, we don't want to, but we may have to because that's what consumers respond to. And I think the whole overhang of the news conference was the Fed is thinking it's going to have a very tough time bringing down inflation because so much of it they can't control. And that just that answer kind of fed into it.
You know Esther George better than anybody in the business. You've owned her for years with Jackson Hole coverage and all that. Were you shocked by her dissent?
We were all surprised. There was a question when we were in the lockup of, I wonder if anybody dissented. And then it was like, of all people. But it probably came about because she didn't want to upset the forward guidance that they had put in place before the meeting. I don't think that she seriously thought there's not an inflation problem.
Mike, thank you. Mike McKee there. The other interesting question was the Wall Street Journal journalist, Tom, asking a question about whether he should have thrown in the towel on his guidance when ultimately there was a feeling that the Wall Street Journal journalist was briefed on the matter.
I know. McKee's got a Graham Banks 48 that's called Fed Whisperer, so, you know.
Looking forward to Jackson Hole, Tom, with Esther George at the end of August. That's going to be an interesting one.
Pioneer Grill, 10 a.m. for a full Wyoming.
You booked the table, have you?
No, it's a counter.
Oh,
it's
right.
Ugly,
okay.
Yellow linoleum.
Nice. You're selling this one.
Counter. You can hook your Tony Lama boots right around.
Lisa can't wait.
Bar, John. Right now, Thomas Purcelli joins us, chief U.S. economist at RBC Capital Markets. Tom, I want to go to your wheelhouse, which is wage dynamics. I look at ECI, I look at wages and benefits, and then I adjust it for Joe Biden's crushing inflation. It's a chart I've never seen. How bad is our adjusted inflation less wages?
Yeah. So so good morning. But can I first say that Mike McKee was brilliant yesterday. I loved all those questions. I think because this is something that we've been talking about for quite a while. This idea that, you know, chasing energy, the thing that you really have very limited ability to control, if any, is a really tricky thing. And I think that this idea that it's, you know, inflation expectations are rising because of it. Look, we're really sympathetic to that. This idea that, you know, on last Friday, I think that the 5 to 10 year Michigan inflation expectations number was more important than the CPI. But I think we need to get to a point where it's probably fair to ask at some point, what is driving inflation expectations higher? Now, yes, today, right now, you can make the case that it's pretty much everything, right? I mean, everything is rising. But I can easily see a scenario where we're getting to the point where it's really just food and energy that's doing all the driving there. And those are the things that the Fed has very limited ability, if any, to control. So I'm sympathetic to the rise in inflation expectations, but I think that it's something that the Fed, I wrote this yesterday, I think the Fed needs an exit ramp from this. Because if they're just going to hitch their wagon to energy prices, funds are going to be meaningfully higher, and we're going to push ourselves into, I think, probably a sharper slowing than we probably need to have. But so sorry, just to say that. And then, Tom, to your question, look, I think it's, wages are going to slow down. They're already slowing down. That's not a guess. I mean, that's just what's happening. And I think if we're right that the labor backdrop continues to soften as the year progresses, I think that will sort of signal what the fate of wages is.
Tom, there's a school of thought, first of all, that the Fed got it so wrong with their transitory thought that they cannot continue to have faith-based policy with respect to how quickly the inflation will come down. But second of all, that if they induce some sort of slowdown now, it will be a shallower slowdown, a shallower recession than letting some of these inflation expectations build. Why do you disagree?
Yeah. I don't disagree. I mean, you know, one of our sort of central frameworks over the last several weeks has been, you know, this could very well look like sort of a 94-95 scenario, right? That classic mid-cycle slowdown where, you know, you had a couple of sectors in recession, you had some job losses, but things didn't get so bad that the NBER actually called it a recession. I mean, that had been sort of our working assumption for a while. And I think if the Fed can find this exit ramp, right, this off ramp, and not have to get too aggressive, I think a scenario like that could still play out, where you have sort of a couple of sectors that are sort of slipping, consumer gets a little squishy, and you have some job losses. But I think again, if this is going to be a chasing energy story, then I don't know what the off ramp on that is. I mean, because I don't know how to no one knows how to forecast energy prices. I mean, let's just be clear on that. And so if you're just going to be chasing energy, then I think you're going to put us in a place where we don't necessarily need to go.
Tom Porcelli of RBC. Tom, great work as always, sir. That's the difficult part of this, and I think Mike McKee got to the heart of some of the problems here, Tom. Just how far, Tom, this Fed is going to push things.
This is an ancient conundrum. We're living in a nominal world. You can get a British phrase, money illusion, whatever you want to say, John. The fact is we're all living nominal and we're all living headline inflation. And in the Fed's defense, there's a lot of research to eliminate out selected things. And, do you take out airfare? Let me know. I mean, just is one oddity right now.
It's getting stickier. And it's got broader over the last few months, too.
I agree.
And clearly they were spooked by that expectations piece of you, Mitch.
Well, they
Lisa, that's fascinating to me.
Yeah, well, you've been saying it all morning. Do we have to now focus on the inflation expectations
yes,
of the University
apparently.
of Michigan, and we have to have a special when that comes out? The key issue for me is that broader aspect. How much and how quickly do rents come down? How much does the cost of healthcare come down? How much do the other costs around services based on how much wages are going up come down? And that might determine the trajectory of what the Fed has to do.
What they can impact in a big way is the housing market. In a massive way. Housing starts down more than 14%. How much more of that are we going to see? Equity futures down 1.76% on the S&P. Kathy Jones is coming up from Charles Schwab, and Vishy Tripator. Looking forward to that a little bit later in the next hour on Bloomberg TV.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The leaders of Germany, France and Italy are in Kyiv today for talks with President Volodymyr Zelensky. Olaf Scholz, Emmanuel Macron and Mario Draghi traveled together by overnight train in a show of solidarity for Zelensky and his government. The trip comes ahead of an expected recommendation Friday from the European Commission that Ukraine be granted candidate status to join the EU. Russia and China are giving differing accounts of President Xi Jinping's birthday call with Vladimir Putin. The Kremlin says the two men discussed economic cooperation, trade and military ties. China says Xi called for peace and economic stability and made no mention of military ties or increasing trade. The two men declared a, quote, no limits friendship in February, weeks before Russia invaded Ukraine. In the UK, the spotlight is back on Boris Johnson's conduct during the Partygate scandal following the resignation of his ethics advisor. Christopher Geitz quit just a day after suggesting in Parliament that the Prime Minister had breached the ministerial code. Police fined Johnson for attending a gathering for his birthday in Downing Street in June 2020 in breach of the COVID lockdown rules his own government brought in. Monkeypox is spreading in Africa, including to countries where it has not previously been recorded. The World Health Organization is raising concerns after cases were found in at least 8 countries, but the agency says at this point it is not recommending mass vaccination. Next week, the WHO will hold an emergency meeting to assess whether the current spread of monkeypox constitutes a public health emergency. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Fed definitely caught up with the market pricing of rate hikes for the next couple of years. So really, that was a little bit more than I had expected. I thought that they would be a little bit more gradual. But you know what? I think that they said they're going to move expeditiously, and they've kind of stuck to their word.
Sabrina Rajappa, SocGen, head of U.S. rate strategy, and thank you to all of our guests yesterday who made for a really spirited conversation, particularly the attendance of Scott Minerd and his comments. Lisa, we've barely mentioned Bitcoin. I mean, Minerd didn't mince words, 8,000.
Yeah, people not necessarily seeing a place to buy given the withdrawal of free money and real yields that actually are real and yielding.
21,000 on Bitcoin right now. Right now, let us look at what matters to America, and it's far more than the economics, finance, investment. It's the stock market that we do. It's about housing. Let us take 4 days across 4 Fed meetings of 2022 and look at the mortgage, the 30-year bank rate fixed mortgage, and the yield has gone up 3.73%, 4.47%, jumping up to 5.50%, and on the 6%, which Julian Coronado noted last week. Kelsey Barrow joins us now with J.P. Morgan as well. Link in the J.P. Morgan world of bonds, yield, price dynamics into real estate in the 30-year fixed mortgage.
Yeah, absolutely. So if you look at the Fed funds rate, it's risen 150 basis points, but the 30-year fixed mortgage rate has risen by double that, 300 basis points all the way to 6%. And we already are seeing the impact on the housing market from that move, and we will continue to see the housing market decline. But I think what's really important to note about this move in financial conditions is it's been so severe that in any other scenario, the Fed would have paused. The reason that they haven't paused this time, despite the fact that mortgage rates are up 300 basis points, is that the inflation environment is just not letting them. And I think what really spooked them last week on Friday is that University of Michigan sentiment
Paul mentioned
report.
that yesterday.
Yeah, absolutely. He mentioned the University of Michigan sentiment ticking up. Now, what we do know about the University of Michigan sentiment data and the University of Michigan inflation expectations is it's very correlated to gasoline prices. And some of that increase in gasoline prices is out of their control. So they're putting themselves in a very difficult situation, but one where they're clearly saying we're going to prioritize inflation over growth.
I mean, Lisa, one of the stories here is oil's only gone 124 to 118 on Brent. I mean, we barely had a pullback, Lisa, in oil.
And it isn't necessarily translating into a pullback at the pump because gas prices, refined goods, are not getting cheaper because of a lack of refineries. How does this really bleed into credit, Kelsey, has been a question that we talked about with a lot of investors yesterday. They were seeing the prospect of wider credit spreads, of more credit losses kind of being implied despite the fact that you don't see near-term maturities. Do you agree that it's the up-in-quality trade going to higher rated debt, or do you think that there's some value given the 8.5% yield and high yield?
Well, clearly financial conditions are tightening and the risk of recession is rising. But if you look at current default rates, obviously they're very low. They need to normalize somewhat. But corporate fundamentals are really strong, and companies have done a number of things to set them up for an environment where we're not particularly concerned about credit losses. They've done things like increase their cash, reduce their leverage, and also term out their debt. So if I look at the high yield market, for instance, less than 6% of the market is maturing in 2022 or 2023. So there's not that much sensitivity in the high yield market, which has become much more higher in quality than it has historically, to these higher rates. Now, I think that there's going to be volatility, and what we're focused on this summer is increasing the liquidity of our portfolios, because the one thing that Chair Powell didn't talk about in the press conference was QT. But QT is happening. We're seeing massive moves, and we want to have the liquidity to sell it when it's expensive rather than need to buy it when there's a challenge.
Lisa, is quote unquote increasing liquidity the same as go to cash?
Well, Kelsey, that's exactly what I was going to ask. How do you do that? Is it with ETFs? Is it with cash? Or is it with the securities that are most traded?
I mean, it is dependent on the portfolio. If you think at the very baseline, we're thinking about, going from off the runs to on the run treasuries, getting out of tips and into nominals, things that are going to have less ability to be intermediated when markets are quiet, when people are going out on summer vacation, and things are more likely to trade with more volatility. So essentially, the bond market has gotten much bigger, and dealer balance sheets have not risen to the same size to accommodate that. And so we want to be prepared when people need liquidity to be able to give it.
This is shocking to me, Tom, and really a reversal of what we've seen for so long when people were seeking out illiquidity. We are looking at the prospect of a Fed-driven volatility cycle that we have not seen in a long time in credit.
I'm just looking at I've been, Kelsey, this has been a crusade of mine, is we're in a bond bear market and nobody's talking about it because nobody's used to it. And the answer is, if I look at the Bloomberg, the Barclays, the Lehman total return U.S. aggregate bond portfolio, these are double-digit losses, right?
Absolutely.
What's the plan?
Absolutely. There's the two sides to that coin, right? You've seen massive losses, particularly in long bonds. The moves in yields, if I look at the move over the week or the move over the month and you compare them to the last 5 years, these aren't just 2 standard deviation moves. These are 4, 5, 6, 7 standard deviation moves. I mean, it's just incredible. But then on the other side, you have the yield, this new starting yield, if you were to invest fresh capital now, that is a lot more attractive. As Lisa mentioned, 8.5% on U.S. high yield is very attractive, and it's consistent with the long-term returns in the equity markets as well.
Yeah, we round up the digits, negative 13% in the U.S. aggregate portfolio. Kelsey, get to work. Kelsey Barrow with us with J.P. Morgan Asset Management, with Bob Michael working there in the fixed income space as well. Lisa, we can't say enough about this because it's all brand new to so many. It is an ugly year for fixed income.
It has been an ugly year for fixed income, which leaves this pivot point. Do people get out and solidify losses, or do they get in because they're actually getting real yield? Yeah, just hold, buy, and hold. It's the old coupon clipping that they used to do. How much are people preparing, though, for that volatility, for some sort of, I don't want to say credit crisis, that's too strong, but kind of what we're seeing, these gap ups in yields, price down, when we get some sort of withdrawal of the Fed's balance sheet. That, I think, is something I'm hearing more and more of.
We got a flighty tape. There's no other way to put it. The dollar's given way a little bit. The yen is having its first good day in ages, 132.75. Euro was a 103 print. We're now stronger euro, 104.34. I mean, Lisa, these are little moves. I don't know. Maybe we're overlooking at it too much.
I think that's the news. The news is that they're not massive declines or massive gains. People are trying to reset and looking for the next compass point. The fact that Jay Powell could raise rates by 75 basis points and people didn't necessarily view this as the world is falling shows how different of a scenario we're in, especially with the 50 basis point rate hike, also from the Swiss National Bank, which was expected not to move yet.
I noticed Mexican peso across the month of June, 4 standard deviations, -2 up to +2 is the move on weaker Mexican peso. We're going to continue through the day, an eventful Thursday, indeed historic, as the Swiss National Bank acts and the Bank of England maybe surprises, not 50 basis points, 25. Thanks to Guy Johnson in London for helping on the Bank of England. This is Bloomberg. Good morning.